With or without implementation of corporate tax in the UAE, international tax itself is an important topic that brings all of us together here on a weekend, Saturday. By familiarizing ourselves with the relevant standards and taking steps to combat tax evasion, we finance professionals help stem the illicit financial flows that constitute an unacceptable drain on public resources. And nowadays, new global tax landscape is evolving. OECD has developed BEPS to address tax challenges arising from risk of base erosion and profit splitting in a globalized economy, which will certainly put an end to the race to the bottom in taxation. As we are aware, BEPS has two-pillar theory. Anyone, what is the pillar one? Oh, okay. Pillar two? Pillar two is very basic. Pillar one is also very basic. Do you know why these are important? In pillar one pillar reference about 750 million euro business, some about 20 billion euro business. So what is for that? Yes. BEPS has two pillar theories. These are intended to transform the international tax perspective. With the implementation of BEPS 2 in 2023, affected multinationals will be required to pay their fair share of tax wherever they operate and produce a profit. Pillar 1, transfer the taxing rights over the largest, most profitable MNEs with a global turnover of over 20 billion euro from their home countries to the markets where they do business and earn profits, regardless of their physical presence. Pillar 2 has a global minimum effective corporate tax rate of 15%, applicable on MNEs with an annual group turnover of more than 750 million euro. These are two basics. Now, as a tax and finance professional, we need to deep dive in pillar 1 and pillar 2. And I think out of 140 inclusive framework countries, 136 have agreed to BEPS 2, right, Mr. Rahim? And 4. You know which 4 are not agreed? India has signed recently. Okay, no one. Google it. Kenya, Nigeria, Pakistan, and Sri Lanka. These 4 are yet to agree to this. Since almost all the jurisdictions need to apply the rule of BEPS 2 constantly, this will result in a more transparent global tax environment, which should level the playing field for the businesses. As a taxpayer, we generally have one common question. And since we comply with all the taxes of each jurisdiction, then what is this international taxation? Again, anyone with international taxation? Have you ever heard there is something called international tax? No. Is this something related to ensuring compliances? Or this term itself is a tax planning or tool to evade tax? No. Or a method of tax planning? It's a method of tax planning. It's a one benefit of this international taxation. So I'll come back later on this. Today, being a globalized market, businesses enjoy access to different jurisdictions and deal with various tax laws that are frequently changing. To succeed in today's global market, it will not be enough for the businesses to simply adapt the individual tax requirements of each jurisdiction in which they operate. Businesses should engage and ensure forward thinking and anticipate or understand the potential short-term and long-term significance of tax planning decisions at a coordinated global level and in context of broader business objectives. And this approach is called international taxation. Today, we have with us our learned orators to share their experience with us on the latest insights of emerging international topics. Speakers will enlighten us that international taxation, now is the definition. International taxation is a study of taxation beyond one jurisdiction. It is to determine the tax based on the tax laws of different countries. Before I go further into the substance, I would like to warmly welcome today's guest speaker, Dr. Ahim Pross, Mr. Fazil Soyufu, Mr. Alastair Glover, and CA Neerav Shah. Chapter Chairman Sri Anurag Chaturvedi, past chairman of the chapter, fellow members, friends, and seniors in the profession, sponsors and my colleagues in the managing committee, and distinguished guests, a very warm good evening to all of you. I, Manoj Agrawal, Secretary of the chapter, welcome each one of you to today's conference on international taxation, and I express my sincere gratitude to today's speakers for accepting our invitations. I also thank each one of you for your active participation. A big round of applause for the speakers and all of us. Thank you. While our speakers will take us through with many exciting topics, it is now time to pay our respects to our nation and profession. May I now request everyone to please rise for the UAE and Indian national anthems and ICAI motto. Technical team to play.
عيشي بلادي عاش اتحاد إماراتنا عزي لشعب دينه الإسلام هديه القرآن حصنتك بسم الله يا وطن بلادي 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 بلاد حماك الإله شرور الزمان أقسمنا أن نبني نعمل نخلص لا نعيش لا نخلص دام الأمان وعاش العلم يا إماراتنا رمز العروبة كلنا نفديك بالدماء نرويك نفديك بالأرواح يا وطن
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः श्रितः सर्वे तदूनात्यधि कश्चन एतद्द्वैता 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 एतद्द्वैता
Thank you very much. Please take your seat. As we all know, in November this year, ICAI India is hosting the prestigious World Congress of Accountants 2022 in Mumbai. May I now request our technical team to play the video of World Congress of Accountants.
Geographically, the 7th largest country in the world. One of the oldest civilization, world's 6th largest economy, a global hub for innovation with one of the largest startup ecosystem. India, city of Mumbai on the western coast of Arabian Sea, among the most advanced and modern metropolises in the world, and the financial capital of India, gears up to host the most prestigious accountancy event of the world, 21st Since the WCOA came into being in 1904, around 10,000 delegates expected to join virtually. More than 6,000 delegates from over 135 countries would congregate to exchange views at the world's most advanced Geo World Convention Center. The theme, Building Trust, Enabling Sustainability, will inspire the future of accountancy profession to create sustainable economies for the future.
The ICAI is honored to be the host for this mega event, which will bring together the world's largest conglomeration of professional accountants, regulators, leaders, and visionaries to advance the cause of the global accountancy profession. Now, with the ease of travel restrictions across the world and the situation returning to normal, we are working towards creating a never before and a unique experience for all our delegates. The year 2022 marks the 75th year of India's independence, and the Government of India is celebrating the year in a big way to showcase the glorious history of India. World Congress of Accountants 2022 would also be celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of the country.
A never before witnessed unique experience of learning future trends, emerging avenues, enhancing skill sets, networking, and to explore the incredible India awaits you.
We at ICAI are pleased to host you here in Mumbai, the financial capital of India, for the 21st World Congress of Accountants with the theme Building Trust, Enabling Sustainability from November 18 to 21, 2022, and give you a professionally enriching and personally rejuvenating experience. We are hopeful that the conference shall be stimulating and productive, and your stay in India will be a memorable experience. Once again, we invite you for this enthralling convergence in India, the land of multicultural, historical, and spiritual inheritance since centuries.
Insights from the stalwarts of the profession, international and national standard setters, regulators, and trendsetters will constitute the panel of speakers at WCOA 2022. Let your dream get bigger. Come, be a part of this mega celebration. For registration and sponsorship opportunities, contact. Organized by Institute of Chartered Accountants of India under the aegis of IFAC.
Thank you very much. Let us plan to visit India in November and register now to witness the most significant conference in the accounting world. It is always essential to recognize the ones who always supports us. Let us recognize our sponsors. Thanks to our title sponsor, Saudi German Health, principal sponsors, Pan Emirates Home Furnishing, AGMC, Tele, Lulu, and IFCO. Platinum sponsors, Emirates Chartered Accountants Group, WMS, CloudSoup, and UHY James. FMCG partner, Aktia, media partner, Khalis Times, institutional partner, Delhi Private School, and banking partner, Bank of Baroda. And for today's event, arranging speakers, a big round of applause for Neerav Shah. Thank you. Ladies and gentlemen, I am sure that today we will gain a unique experience by enhancing our knowledge of international tax and its modalities, which should sharpen our skills for the upcoming corporate tax environment in the UAE. The OECD has been at the forefront of fighting against tax evasion, ending secrecy, and tax havens. We all know that OECD is a very immense and imperative organization, and there is one unit that creates all these policies, procedures, and compliance metrics, and increasing our work, which is the Center for Tax Policies and Administration, known as CTPA. Do you know how many tax treaties are there across the world? Any rough guess? No one? Okay, 3,000 bilateral tax treaties. And the OECD's Center for Tax Policy and Administration is bringing tax experts together to support the member countries in formulating cohesive tax structure to avoid tax evasions with the introduction of the Model Tax Convention. And with the inclusive approach of the Center for Tax Policy and Administration, OECD is ensuring that these solutions are fit for a modern, globalized, and digitized economy. I believe this should increase our curiosity to know more about OECD's recent developments and their impact. Who else can be better person to explain this to all of us than the head of International Cooperation and Tax Administration Division of OECD's CTPA, our today's guest speaker, Dr. Ahim Pros. And to introduce Dr. Ahim, I would like to invite our Vice Chairman, Sri Harikishan Rakawat, to the stage.
Secretary Saab, just now he mentioned that our work is getting increased. Sir, our fees is also getting increased. Because of that, all the consultants are very happy to see so many tax compliances in the country after a long time. And as you guys are aware, that VAT was implemented on 1st of January 2018. Then ESR got implemented in the year 2019. Then thereafter, UBO got implemented in the year 2020. And AML law got implemented in the year 2021, and new companies law, which was implemented on 2nd of January 2022. And 2023, you are aware that corporate tax is going to be implemented. So we are going to get definitely a lot of work, and all are very happy to see a lot of work. Today, as you know, that we are having International Tax Conference, and I would like to thank our learned speakers for joining here from various parts of the globe to address all of us. Now this is my pleasure and privilege to introduce our first learned speaker, Dr. Ahim Pros. He is the head of the International Cooperation and Tax Administration Division within the OECD Center for Tax Policy and Administration. He has responsibility for setting up the standard for automatic exchange of financial account information in tax matters. He is addressing the tax challenges under OECD, which are arising from the digitization of the economy and many of the BAPS actions. He joined the OECD in 2001. Prior to joining the OECD, he worked in the tax department of a large US law firm, working from office in Washington, DC, Paris, and London. Previously, he was an assistant at Munich University's Research Center for International Tax and Financial Law. Dr. Pros is a lawyer by background. He received his legal training at the University of Munich, the London School of Economics, and Georgetown Law Center, Washington, DC. He holds a PhD in international taxation, and he was the winner of the International Fiscal Association's Carol B. Mitchell Prize in 1997. He is a regular speaker actually at seminars, conferences, but particularly in government seminars. Generally, he is not available as a speaker for the private events like this. And thank you very much, sir, for accepting our request. And thank you very much to Nirav Sai as well for bringing him here. So we are really very fortunate to have you here. And now, can we have a big round of applause for Dr. Ahim Pros?
Thank you for the nice words of introduction. Before I start, I think I have about 40 minutes. It's a big audience now that I get up and I see you all. Thank you for the invitation. As we said, it's exceptional. Normally, we sit in our offices, we come up with yet new ideas that create even more work for you. So more business is coming your way. So don't make us speak. If we speak, we can't create work for you. You just listen to us and you can't build that. But at least sort of starting slightly jokingly, I think there's at least two reasons that brought me here. One is the experience that you've probably have in the past, that there is no way you can say no to Nirav. You can try and you can say no once, but he will ask again and eventually you'll say yes. So thanks very much for having been insistent. And of course, slightly flippantly, it's also refreshing to finally be in a country where people can actually pronounce my name. And if your name is Achim, then you will understand that that is in many parts of the world quite a difficult one, but this part of the world it is not. So it is a pleasure to finally hear my name as it's meant to be pronounced, and not put and chopped into pieces like in the UK and other places. Achim. But now moving on slightly more seriously to the pillars. I think staying with the theme here that we are with chartered accountants and looking forward to your World Congress, building trust, enabling sustainability, the tax world is now entrusting you with a lot of the inside of the pillars. So if you're thinking about more work, you got it cut out for you. And that is because those pillars, if they come, and we'll talk about it, effectively don't use tax accounting, they use financial accounting. They apply concepts of consolidation, and you may believe that we have a couple of lawyers that are now panicking because they have no idea how they're ever going to advise on the pillar, because 80% of the pillar is based on financial accounting. And if you don't understand financial accounting, how are you ever going to advise anybody on whether they're in scope, what part is in scope, what income is in scope? And then you have to go to lawyers. I'm a lawyer myself, and you have to explain to them deferred tax accounting. And then they say, like, what is that? And then we say, well, it's not only deferred tax accounting. In fact, you need to make adjustments to deferred tax accounting. So you need to adjust a concept that you don't even understand in your practice. And then you need to bill clients for that. So the world and the world of the pillars needs you. And that is, of course, another reason that I am here, less jokingly, because it's very important that for these pillars to proceed successfully, that sometimes we break down those silos we have in firms and corporations, and sometimes even in the advisory practices between the tax people and the accounting people, because these pillars will only work if you work together sensibly. And that also means that we have a shortage of trained accountants in tax administrations that will make sure that this is correctly applied. We also have a shortage in firms, sometimes where there is the accounting people, but the accounting people sit over here and the tax people. And that maybe is just by way of context. But in order to stay in my allocated time, and I could talk about this forever, but I won't, what am I going to talk about today? And I'm assuming you know technically relatively little about these pillars, so some of it might be too basic for you, and I can go faster. I tend to not be able to go slower, but I can go faster. Just to give you a sense, we have 2 pillars, and we were trying to break this down, 2 pillars in 10 questions. And we cheated a little bit because we had one more question on pillar 2, but it would have been 11 questions, and that doesn't sound good. So we got it down to 10 questions. So we're going to talk about why are we even doing these pillars? What are these pillars? To give you some sense, and thank you for the introduction already. Then there's a question of gross versus net, and most businesses are pretty clear, like if you're going to tax me, please tax me net and don't tax me gross, but then you have to compute net, and this is also where you come into play. Then there's the big question on pillar 1, the so-called digital pillar. What is digital? Isn't everything digital? Or what's not digital? Where do you draw the line? Then a very high-level overview of how this thing actually works. Like, what is this? What are we talking about? Then I guess sort of a sense, where are we and what's going to happen next, and when is this going live, and when do I need to know about it? Because sometimes what happens at these very global projects that we do at the OECD, where at the moment we have, as you said, 106 plus countries sitting around a very big table, so it is a very big table, and post-pandemic we're now bringing these people back, and everybody other than China is now traveling, so we are actually bringing them back in a room much like this with a much bigger table where they all sit around. And so then you also bring these different perspectives. India is very much engaged. China is very much engaged. UAE is involved. So you bring all of these people together to explain you a little bit the process and what comes out of this process, so you can picture it a bit. Because what then happens is it can take forever and ever for this decision to come along, and you think, well, why should I be reading this? But when it happens, sometimes, as we've seen with bank secrecy, it happens very, very fast when it happens. And then you need to be prepared. And then you can't start the preparation the day before it comes in, because you will not get to the finishing line. Then I go to pillar 2, similar questions. Before I go into the pillar 1 and the pillar 2, the 2 pillars, in a nutshell, the pillar 1, as you have said, is essentially giving a new taxing right to the market. Source residence. It's not base erosion profit shifting. It's not that there's bad business and they're gaming the rules. It's that we're saying after 100 years, since the League of Nations came together in the 1920s and came up with taxation concepts that made sense in the 1920s, 100 years later, we're still using the same framework for the allocation of taxing right. We say, do you have a physical presence? Do you have an office? Then we give you taxing rights. And as we all know, in a digital age, we don't need to have a physical presence to be present. I can be extremely present on your phone. It doesn't matter whether I have an office. Sometimes I actually don't need an office anymore because I even deliver my services through the phone. And so after 100 years and the League of Nations, we said now it's time to look again about this question. When do you have a right to tax for corporate income tax a foreign company? That's the first pillar. The second pillar is the so-called global minimum tax. It essentially says that we will develop a system, and I will try to give you a sense of how the system is meant to work, that ensures that every large business, and as you said, those with a revenue threshold of above 750 million euros, or the local currency equivalent, that they will pay an effective minimum tax of 15%. There's also something that we can talk about a little bit, because the Pillar 2 has a second component as well, and it is the so-called subject to tax rule. That is not relevant to a large number of jurisdictions because most jurisdictions have a nominal corporate income tax rate of more than 9%, but not all of them do. And so when we find ourselves here and in this region, of course, this is also a relevant provision. However, that is only relevant to the extent that you also have a treaty with a development that asks you to put this provision in your tax treaties. So it's much narrower scope, but it's part of the Pillar 2. So let me take you quickly through some of these slides. Sometimes I go a bit faster. We can make the slides available if people want to look at them after the meeting so that I don't need to talk you through to things that may not be that relevant. So why Pillar 1? Why the digital pillar? Why are we coming together to talk about this? One, I think, as I already said, after 100 years, maybe it is time to have another look. Businesses have moved on. We can all be somewhere where we have no physical presence. If you go back to the BEPS action plan, it was our first action item. Action number 1 of the 15 actions was digital taxation. But the BEPS project, as you said, was a project about base erosion and profit shifting, avoidance behavior, if you wish. This is a different question in Pillar 1. It's a question of, even between high-tax countries, between the US and India, taxing rights on digital businesses, should they be triggered or not by physical presence? And then if you're a tax person, and I recognize several you're not, then you also recognize that there's a such thing called transfer pricing, which then basically means that even if you have a presence, that's good. But that only gives you a taxing right, but for how much of the profit? Because if you taxed 100% of the profit in every country where you have a presence, you would tax the profit 100 times. So then we need to separate out the profit in the branch, if you wish, in the presence, with the rest. And this is what the OECD has always done through its transfer pricing rules, to split up the profit so that you do pay once, but you only pay once. And so if you create a taxable presence without an actual physical presence, which is what this does, you also need new rules of profit allocation, because the profit allocation rules inside transfer pricing use functions, risks, assets, a physical dimension that doesn't translate into the digital space. So we needed to change this as well. Then if you flip over, people were not completely happy with where we ended up in BEPS under transfer pricing. I'm not going to go through the details of transfer pricing in this group, but people were not fully satisfied that these rules of splitting up the profit worked in the 21st century. And why did they think that? They think that because much of the profit drivers, and we're talking here in Pillar 1, very large businesses, are self-created intangibles. They're not importing and exporting cheese, which we can measure and we have comparables and we know what the margins are. These are highly integrated, novel business models that operate of unique algorithms that they have developed, and the valuation of which is extremely difficult. And then telling people where those profits drivers are, if you just step back and you look at a company like Google or Apple or some of those, where do these people sit? Where do these assets sit? Where are these risks that you can split up 50 billion in profit. Does 10% go to this country and 12 because there's these people? Or maybe these other people are more valuable. Or maybe it actually isn't the people, it was something else. And how much of that something else do you allocate? So you can see that transfer pricing rules are struggling inside a very large, very profitable, highly integrated business to separate out the value drivers to give all these countries where you have a presence their fair share. Politicians then easily say, we need to all pay our fair shares, but then it comes to us and you to say, well, now you calculate a fair share, and translating this concept in a number is much harder than articulating the concept. So that, I think, brought us to the reflections on Pillar 1 in terms of the conceptual underpinnings. And if you look beyond, as we do, to academia, civil society, you also see that people said this system needs a change. 100 years is a pretty good run for like some principles, but now it's time to change. We cannot have a situation where a company is present on 40% of the population's phones but pays zero tax in my country. That is not sustainable. Also as a political matter, society doesn't buy it. It's not sustainable. It also then means that people will start to act. And that is also consistent with what academics were thinking. But nothing happens until you have an event. You know this. Typically, there is a situation, it's not stable. We all know it's not stable, but it might last forever. Your wife might be telling you have to fix the kitchen. You never fix the kitchen, and for 20 years it totally works, but at some point it just breaks. And this is then what is the next step. This is, you need an event, something that triggers from an unstable situation into action. In 2016, the Republican Congress, not the Senate, it didn't become law, went for a bill, a so-called destination-based cash flow tax, where they said, we're going to tax in the market, a complete novelty from the perception of America, always historically perceived as the residence jurisdiction, right? Something that you would expect India to do, not the United States. Then in June 2017, a French court said, Google doesn't have a permanent establishment. Bringing that issue to the fore. You have this very present company everywhere, but it's structured in a way consistent with the rules as the court held that there just wasn't a PE, couldn't tax it. That generated a letter that went to the Commission in Europe, and the Commission started to work on the so-called DST. And India was very proud because India had already thought about something like this. And now the Europeans were going Indian, and the US was getting nervous. Because all of a sudden, there were all these places that say, well, you know, if the system doesn't change, then maybe we need other levies, we need other measures. We don't, like, nobody's going to change my treaty. I don't have a taxing right, so I'm going to create a taxing right. So we came with digital services taxes, substantial presence concept, all sorts of equivalation levies, other features where you saw the system was not stable, it was changing. And that brought the OECD in. And I'm going to get back here briefly. That brought the OECD in because the Germans, and I am a German, had the G20 presidency and said, ooh, 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 ooh. I'm getting very nervous here. The Germans have a large export industry. They need stability in the rules. Germans love stability over practically everything else, and this was an unstable system, and Germans cannot cope with an unstable system. They need to book their vacation 10 years ahead of time. They need to know where they're going. They're putting their towels down. You can't tell them next year, I don't know. Maybe the system changes, maybe it doesn't. Not a problem for an Italian. Probably Indians can also deal with change. They're used to it, but Germans cannot deal with unstructured change. So Mr. Schäuble, the finance minister at the time, said, the OECD needs to accelerate. We're happy to change the system, but if we change the system, we need to change the rules for everyone, so we again have a system rather than a breakdown of the system. So then the G20 said, okay, bring it forward. Focus on this piece, which is, I think, what we then did, and we looked at short-term and long-term, and we said, and this, I'm going to go a little quicker here because we get a bit of the technical. The first debate we then had at OECD and in the EU and in other places, gross versus net. A DST is a gross tax. It's always easy to tax a rich foreigner. It's actually popular, right? Because foreigners don't vote. If they have a lot of money and you tax them, it's actually popular. The problem, of course, as you would understand, is if we all tax rich foreigners, we're all foreigners somewhere, like somewhere will tax us. And we're probably foreigners in more countries than we're not, so we end up with triple, quadruple taxation, right? So as a viable concept, when you look at this not individually in one country, but collectively as this planet, It is a highly inefficient form of taxation that will reduce prosperity dramatically. So it was quite quickly that we realized that growth is simpler, but it's not the long-term solution, because it creates even more problems than it solves. I'm not going to take you through these subheadings of all these people exploring various approaches to gross taxation and the ease of administration. All of this comes with it, but as a concept, everybody agrees that's not great. So we said net's the better response, but then we also need to say, well, then A, it's more complicated, which is B, we need your help, because we're going to rely on financial accounts. And then this is a question for those that are interested in the topic. It came about with the digital companies, right? People were thinking Google, Apple, Amazon, Facebook, Meta. But then people said, well, if you then actually have to draw a line, the digital companies that can engage with your customers without having a physical presence, where is the line? If you go to a website of any company of any size, it will probably tell you that it's a digital leader. Everybody is a digital leader, because if you're not in digital, you're probably not in business. So then where do you draw the line? And also, when you draw the line today, we don't want to come together every year and redraw the line. So you need to future-proof the line. So where is the line? And we started out with social media, and we said we're going to give money to the market. The YouTube cat. People were illustrating this, yes. So there's an old lady that has a very attractive, very cute cat, and she puts it on YouTube. And it makes a lot of advertising money because everybody wants to see the cats, and advertisers are coming in, and this cat is a millionaire. But then this money doesn't go to the cat. It doesn't even go to the old lady that put the cat on YouTube. It goes to YouTube. It goes to the US. This is wrong. It needs to go where the cat is. I am simplifying, admittedly, but you get the concept. Like, we needed to go into the market where the networking effect was actually being created rather than just providing the platform and the infrastructure. And then other people said, well, that's a bit too narrow, because you can also withhold a brand from the market and make a lot of money, but not giving it to the market where you have the customer. You might be selling a handbag if it has a brand for 10 times the price for the same handbag without the brand, and where does the brand profit go? And aren't we saying that the future is really intangible property? And if we're saying that the future is intangible property, then it could be any business that is affected. And so, as you can see, this journey here, I'm not going to take you through every step, but it was a long journey that took us from a relatively narrow focus on digital for a bit of a wider focus. You also realize that when you look that actually the business model of Apple has nothing to do with the business model of Facebook, apart from some business activities. So already this digital notion was not an intellectually terribly sound notion once you try to break it down. To a consumer-facing business, to largely where we are now, and where we are now is, it is for the largest businesses in the world. 20 billion revenue, 20 billion, not 750 for Pillar 2, 20 billion and a 10% profit margin. But in 7 years, that's going to go to 10 billion. And then we'll see what happens. So it is a small group, but if you look at residual profit, of excess profits, it's a pretty sizable pool of profits, because in this race to the top, you see that the winner doesn't take it all, but the winners take a big chunk of all. And so when you look at the total profit that is in the Pillar 1 pool, it is much bigger than you would imagine by just looking at the number of the companies affected. And also have in mind that this eventually will go down to 10, and then you bring in more companies, and we see where it goes. So I think that's the journey of this. Now, in a nutshell, and this is the relevant part for you today, or perhaps tomorrow, or the day after tomorrow, how does this work if you are in scope? Apple is in scope. Procter & Gamble is in scope. There's a couple of companies, there's luxury companies that are in scope. We're going to take 25% over 10%, determined on the basis of, this is where you come in, financial accounts at a consolidated basis, with a very limited number of book-to-tax adjustments that we do need to make, because it's still a taxing concept that builds on an accounting concept, but it's still a taxing principle when we give the money to the market. And we're going to give those 25% to the market, and we're going to break it down by reference to sales. So we're going to have a sales-based allocation of 25% over 10% to the market. So far, that's the broad concept. Doesn't sound too complicated. Once you go into the detail, it does get more complicated, because also you then have to eliminate double taxation, meaning what you now give to the market isn't new profit that you have probably discovered, right? This is existing profit. So now you need to avoid double taxation by giving extra relief on that portion in the jurisdiction where that residual current profit is currently taxed. So there's a component where you give it and where you take it from, because sadly, as much as we would like it, we can't just double the profit. And all of this comes through a quite revolutionary early tax certainty process, meaning there is a panel of tax administration officials that sit together, that give the company early tax certainty where that money is going to go and where this money is going to come from. Because you cannot do it separately. You cannot have 140 tax administrations separately auditing business line segmentation, revenue sourcing, book-to-tax adjustments. It's impossible. But there's a big job that will have to be done when if Pillar 1 comes, in making sure that that information is available, that that information is correct, the right book-to-tax adjustments have been made. And that is a job where I think you will also be playing a key role. I'm going to skip through these slides because that is too much detail. So I've included it. We can make it available so you can read it at home, ask me questions. These are the different building blocks, all of which are relevant inside the Pillar 1. This is where we are. There's a business consultation going on each building block, so we get business input on revenue sourcing. How does this work? How does it work for components businesses? How does it work for consumer businesses? So that these companies, 100 to 150 of the world's largest and most profitable companies, can handle this. And then, of course, there's the question that's the end of the Pillar 1 here. There's the question, what happens next? I need to go back tomorrow because we have a July output, and if you look at the calendar, that's pretty close. So we don't have a lot of time to lose. There is the question of taxes and beyond, and that is important, because the United States takes the position that if you enact a DST, it potentially triggers a visit from the trade representative, and you will be slapped with a US tariff. And so part of the pillar is not just tax, part of the pillar is also trying to remove trade frictions that we would otherwise have. DST, punitive tariffs, more taxes, more tariffs. Given all the tensions in the international system, we certainly are trying to remove one tension. We have plenty of tensions. This is a tension that we can hardly afford and we don't need, but it's important to bear in mind that this pillar has a relevance not just for taxation, looking at it since we haven't for 100 years, but also it removes what otherwise would be a trade conflict, certainly with the US and potentially also with other countries. And then finally, we actually think that if you step back and you think about the pillar, it may be an attractive taxation regime if you think about it from the perspective of a large, highly integrated company, because you get upfront certainty, you can largely rely on your financial accounts. It may eventually, there's complexity on the way in, but once this is in cruising altitude, if we ever get it there, it may be an easier world than you face today. Now then, the last question, have I just wasted your time? It is possible that I have, because this pillar will have to be ratified. It requires a multilateral convention, including a multilateral convention that would have to be ratified by US Congress. It is not something in the current environment of a certain lack of bipartisanship that would typically come. At the same time, if there has been one thing that has been bipartisan in the US, it is Pillar 1. The US, bipartisan, both sides have consistently sent us the message, including in recent letters again, that we need an OECD solution. The idea of an OECD solution on a net basis has broad support in Washington. But of course, we need to see what happens. And we'll need to engage when we release it. I think there's an engagement with business, there's an engagement with both parties, there's election coming up, but I need to just tell you, I've stood here, maybe I come back and then you tell me, well, you told me all about this Pillar 1, it didn't happen. Then at least I can say, I told you so. So that's my get out of jail card to say, so far, this has not been ratified and it will require changes to treaties and it will require ratification in many parliaments around the world. So that with a bit of caveat. That's Pillar 1, and now I'm going to race you through Pillar 2, because that is closer to completion than Pillar 1. What's Pillar 2? Pillar 2 is the global minimum tax. Again, it relies on financial accounts. So the tax people are putting the trust in you because you're building trust, and we're trusting you because you're building trust, as I learned. Pillar 2, where does it come from? And now recognizing where I am, you think like these people are crazy, right? Because we're in a country that is about to introduce a corporate income tax, and we're already talking about a global corporate income minimum tax at 15%. So you know, that's quite a step. If you've recently arrived from India, then probably you find this less novel, because India does actually have an alternative minimum tax concept already that is also largely oriented on financial accounts. Maybe, and I'm doing this relatively quickly here, why after the BEPS action plan did we think we had to top it up with a global minimum tax? Like, didn't we do all these actions, Action 5, Action 3, interest limitation, and all these other things that have changed the world and have been, as you pointed out earlier, implemented here and around the world? 3 reasons at least, and maybe 4. The first one is that many countries in the world have controlled foreign company rules. Now, part of the reason BEPS got started in the first place was check the box, for those that remember check the box. There was a lot of talk in the news and everywhere that large US companies weren't paying tax on their foreign earnings, like it's 0. And this against a backdrop, and I think that's important, where tax is political. Not like 20 years ago where tax was something for the technicians and we just did it and nobody cared. It is extremely political. Globalization has happened, inequalities are extreme. The sensation and the notion that rich people, speaking simplistically, and large businesses don't pay their fair share resonates. It's a political topic. It's a political topic in India. Every other scandal can have an impact on elections, and that is true across the world. And so tax is extremely political. And so this notion that large US digital businesses had an inbuilt subsidy de facto because they didn't pay tax, and then all of a sudden your local shop was going to disappear because this giant that didn't even pay tax was going to take over the world and your economy, it resonates much more widely than tax. And this is why this is such a focus here. This is not just tax technical, this is wider society, equality, change, globalization, what does it mean type questions. And in Action 3, we didn't deliver much. We didn't deliver much because countries didn't agree. Then we had something about harmful tax practices, Action 5. And you need to tell me when I go slightly over time. You give me a sign, and then exactly I'll cut it off. Action 5, harmful tax practices, which basically only happens if you have a corporate income tax. It's basically countries with a corporate income tax that say, like, I really like what, you know, Dubai is doing, but maybe I can have a small little island in my little ocean of corporate income tax. I can carve out a space, a protected, nice little space where, yes, everybody pays 28%, but these guys don't, because they're in this space. So everybody created a little bit of a space. And typically this space when you had positive externalities. So what is this? R&D, research and development, incentives for R&D. Because of course, you know, one, it's much easier to do it inside the tax system. It's a lot less transparent that you're actually giving a subsidy, which, you know, if you give a cash subsidy, that's a much more complicated political process. So if you do it in the tax system, whether you do it as a credit, you do it as some other form, and then the patent boxes became popular. If you have R&D income, you only pay 5%, and then you need to measure what that is. And if everybody does this, come to me and you get a patent box, then we had this race to the bottom effect. And you can see this. You know, it was 10%, the next country had 8%, and then you come to me at 6%, and then how about 5%, it became 4%, and then you get to 0%, and that's where you are in many of these patent boxes. You have patent boxes with 0% in a number of countries, and people were sort of unhappy. And when we did our project, what we said is, if you want to do a patent box, we think it's economically not terribly effective, focus on the deduction, don't focus on the income if you want to stimulate R&D, but you know, that's your decision. But if you do, don't make it bigger than this. So we put a box around the box. Don't make it bigger than this. But the public narrative became the complete opposite. We had an OECD globally endorsed, 130 countries have said that this is a certified patent box. So everybody started doing them. It had the exact opposite effect. We thought, okay, we put a stop to patent boxes, but we did the opposite. We actually sold patent boxes because they had an OECD logo on it, and everybody said, well, that's a good box, then I must be doing it. So people were unhappy because they were intending one thing and they got the opposite. And then finally, The transfer pricing rules, which I skip a bit here, also didn't quite get you there. You couldn't do a cash box anymore, so you couldn't cost share into a tax haven and claim because the contract was not a sham, like all of the income would go there, so you had to have some people, but not a lot of people, and it was quite difficult to operate also. And then, if you go to the society more widely, if we go to people and say, look, we have stopped the race to the bottom, because there's now substance and there's transparency and exchange information and bank information and other information, corporate information, so there is no more race to the bottom. In the minds of politicians and the society at large, tax haven is determined by reference to the tax rate. It's just a fact. That's how politicians think about it. They think about rates. They think about not any difference in the rate, but very substantial differences in the effective tax rates drive the thinking, drive behavior. We had it as gateway criterions, but not as a standalone criteria. And so that then also resonated with the academia that also told us, look, if you want to stabilize corporate income tax, you need to anchor corporate income tax in things that tax lawyers can't play with. And what is that? The residence of the shareholder, because the shareholder doesn't move, at least not easily, and their customers, because they need to sell their products. They will go where the customer is, so if you anchor it with the customer, you stabilize corporate income tax. So you see this all out of this emerges over probably 2 decades of policy evolution, the notion of a global minimum tax. And then, as always, and like Pillar 1, you need an event. That's all fine, academics can write paper about it and assert it, but does it happen? No, but when does it happen? The US enacted GILTI in 2016, December 2017. GILTI is the first global minimum tax. And in fact, GILTI was in the Action 3 report because it was already at that time that the US Treasury was thinking about doing something like this. So then people see it, and as often happens, the US goes first, and people say, I want that too. And so you see the dynamic, like, if they're doing it, we shouldn't be doing it. They shouldn't be taking all the money. I also want to take some money. This makes sense. Plus, we'd already discussed it amongst all these countries in Action 3. And then you have this combination, the digital giants. The digital giants don't pay tax in the right place. They should be paying where the cat is, right? But also they should be paying tax, and they're not paying tax. So it becomes this convoluted notion in a narrative where one goes into the other that says they're not paying tax and they're not paying tax in the right place. It's both, Pillar 1 and Pillar 2. And then, of course, the last part is also whenever you have a large negotiation, and the same is probably true for you in your practice, if you want to come to an agreement, you have to have a wider package on the table. It's a bit like a menu, right? You can take certain parts out. I don't like this dessert, but maybe I take another dessert. I take this starter, and maybe we drop the main course, add another main course. And then there is in it something in it for loads of people around the table. If you start very small, they either like it or they hate it, you never get a deal. If you have 10 things on the table, well, maybe you like this enough, and so they come along. And it's no different in international diplomacy and politics. So then, and maybe I stay a bit high level here on the technicalities. How does the global minimum tax work? First, if you're below 750 and you're not in a country that wants to apply this to its own people at below 750, and there's some in Latin America and other places, then you can stop listening. But if you are above 750, or if you expect to be above 750, then do read on. There is a common tax base, and this is where all of you come in. Because what we do, and I'm going to use an example. If you have a German company, I'm the German company now, and it has a UAE group that it owns, and it also has a subsidiary in the UK, because that's what I'm looking at. Then what happens? We're going to look at the operations they have in all of the places where they operate, in the UK, here in Dubai, and in Germany. And then we're going to determine the income for every jurisdictional group. If it's a constituent entity, if it's an entity, we use the entity information, but we start with the financial accounting of the parent. And then there's some simplification, so we have one consistent number for our operations in these 3 countries, right? Now, there may be a branch, and so then financial accounting doesn't tell us about how we split the profits between the branch and the head office. So we have rules in the pillar. There's a big book, I brought it for you, that says, how do you split this up? And if you have a partnership, there's another rule, because we also then need to assign the income in a partnership context. And then we're going to develop the income of, let's say, the Dubai 2 companies that exist and the Dubai branch, and we're going to put this income together. And when we calculate the income, we're going to start with financial accounting, but then we're going to make adjustments. And that's also where you come in, because you need to understand the financial income, the financial accounting discipline, and then you need to understand the adjustments. And then we're going to do this for the 3 countries. And then we're going to look at the taxes. We look at the taxes that you pay, but we're also going to look, and this is also where you come in, at the taxes you accrue. We use deferred tax accounting, but we use adjusted deferred tax accounting. Certain deferred tax accounting concepts we follow all the way, others we do not. For instance, if you claim a deferred tax liability, but it doesn't get paid in 5 years and there is no exception, then we'll force you to reverse it, because we gave you credit for a tax that you didn't pay, but you only accrued on the assumption that you would actually pay it. If it turns out you never paid, you don't get a credit. So there's a couple of these things that you do. And then when we're done with the calculation in these 3 jurisdictions, and we've calculated the income, and we've calculated the cover taxes, we create a simple ratio and we see, well, what's your effective tax rate? And if your effective tax rate is less than 15, you have a top-up amount. So if you pay, let's say, in your Dubai operation, you pay 9, suppose, it might not be 9 because it's based on a different base, but it's 9, then you owe 6. And then the question is, where do you pay 6? And this is the question of rule order, so to speak, where we say CFC and reverse CFC. You would pay it primarily in the parent jurisdiction. So if I'm the parent jurisdiction, I'm happy now because I get an additional 6. Germany gets 6. If Germany does not introduce the income inclusion rule, the CFC rule in this example, the money would go to Alistair. So now the UK gets 6. But then, as is maybe also the case here, people will be thinking where there could be tax, where there could be low tax, right? They're saying, well, if somebody is going to take my money, why don't I take it? And so there is also the possibility that countries will be introducing so-called domestic top-up taxes, because they say it's basically, the concept is quite simple. If you leave money lying on the table, not everybody can grab it at the same time because that is chaos, but we have created an order in which time people can grab that money. So if you don't take it, we say, would you like it? And if you don't like it, we give it back to the other person, but somebody will take that money. And if somebody takes that money and it's actually your money because it's income earned in your jurisdiction, you probably end up saying, well, then I take the money. And that's the qualifying minimum top-up tax. Now, that is something where countries need to decide what they do. They can decide to bring in a qualifying minimum top-up tax or not. They can decide to bring in an income inclusion rule. They can decide not to do the pillar. So countries are free to decide what they want to do, but if you think through the behavioral dynamic, if somebody starts to do it, others will likely follow. It does need a group, a critical mass, so to speak, of countries to start, but once they start, it's quite difficult to stop because somebody picks up the money, and if it's your money, then you may want to hold on to it. That, I think, is what is explained probably in more complicated terms on this slide. One other thing I would mention that you see here on the bottom on the left is the so-called substance carve-out, and that's an important notion. That means that, for instance, if you, because I got the question this morning, if you're in a free zone, as might happen, and this free zone extends to corporate income tax benefits, what happens? The notion that people have in mind in the global minimum tax, in their minds, it's an operation with very little substance and very big profit. Doesn't have to be, but typologically, that's kind of like what people have in mind. So after a long discussion between very, very different countries, and you may imagine that the position with respect to a global minimum tax that Singapore would have would be quite different to what France would have. And so, we all had to bring them together with compromises and long discussions. And one of the things that came out is the substance carve-out. The substance carve-out, and again you come in, the substance carve-out says you will look at the expenses you have in a jurisdiction that relate to tangible assets and payroll. And there's a definition of payroll and what's in the country, and there's a definition of tangible assets, and you calculate this. And then you have a markup of an accepted percentage. And that part gets removed from the minimum tax. So it doesn't matter what level of tax that bears because it's taken out from the minimum tax. Because that, in some sense, you can argue, is a routine return associated with substance in the country, and other countries shouldn't touch that. So you do with that what you want. You tax it at a high rate, you tax it at a low rate, you don't tax it at all. It's your preserve. What is being taxed is the so-called excess profits, which comes back to the intangibles. It's a crude way of calculating intangibles, but it's that idea. It's that excess profit that may be in your country, but it's really not necessarily connected to your country. You could use tax principle and have it arise somewhere else. So it's less firmly connected with your country. So there's a protective zone, if you wish, that Pillar 2 does not touch, and that is the substance carve-out. And that is the bigger the base is. So the more people you have, the more tangible assets you have, the bigger that amount is, which also policy-wise makes sense because there's more substance, less concern about profit shifting in the pillar. We're currently, and then I'm running to my last slide here, working through at the OECD with 136 countries, clarifications. There's a lot of clarifications. I'm having discussions on a daily basis with industry, with advisors, with trade associations. They say, here's this piece of the rule that doesn't work, and here's the fact pattern. Or they say, I don't know whether it works. Can you explain how it applies to those fact patterns? So we have, you can imagine with 136 countries, at least every country has a top 10 list. So you do the multiplication, then business comes in, we have a very long list of questions. And we're going to go through them. We're going to do that. The second point is administrative procedures. How do you take this from the company's accounting systems and financial reporting systems into a tax return? How do you exchange it? How do you stream the information? How do you work with tax administrations to do that? Number 3 is simplifications. Is there ways that we can make these rules simpler to apply in practice? So for instance, if you're in a jurisdiction with a high corporate income tax rate where you kind of know that the ETR is always going to be above 15, is there ways that you can avoid having to calculate it only to prove something that we already know? And then finally, how do we do rule coordination? So I know when, the income inclusion rule deactivates the other rules, so I don't need to apply them, where we will provide guidance and lists effectively of all countries that have good income inclusion rule, good undertax payments rules, good domestic tax, top-up tax rules, so that the coordination becomes easier. And then also aspects on dispute resolution if 2 countries actually disagree and you end up allocating out the same top-up amount, the 6. If too many people grab the 6, what do we do? And the round table, I guess you get the picture of people rushing to the middle where the cash is. So these are the things we will be doing between now and the end of the year and then continue in the next year. And then maybe, and that I think is my last slide here, have I wasted another half hour of your time with the Pillar 2? Because the Pillar 2 so far is a book. It's a fully drafted book. It has rules, but it isn't the law in any single country yet. Now, crystal ball, will it be? We never know what the future holds. Perhaps you do because you're accountants, so you have to defer tax accounting principles. You have to think about what is the probability of this. You would probably create, I don't know whether it's an asset or a liability if it comes in. So that is the big question. The next one I think that will happen is the European Council gets together Friday in a week, and on Wednesday we will know whether it's on the agenda. And if it doesn't happen there, it could still happen under the Czech presidency. We know that it's a proposal in Canada, it's a proposal in the UK, there's proposed draft legislation out on which HMRC and HM Treasury are consulting. We know there's drafting going on in Japan. My team was in Malaysia last week. You see it popping up everywhere. So I would guess that if the Europeans EU acts, we see quite quickly. Then there's of course the US. The US has a proposal on the table. That is a revision to its existing GILTI system that brings it into the same fold as the OECD jurisdictional approach to Pillar 2. We need to see whether this gets legislated before the summer recess or not. So at the moment, I can leave you with this. I hope you find it interesting. We don't know what the future will hold, but I can show you many bright things ahead, and if they happen, from the perspective of a chartered accountant, it certainly means more work. So with that, I conclude. Thank you very much.
We'll have a couple of questions for Rahim. So if you would like to ask.
Now that in UAE we have the corporate taxes, as you rightly mentioned, now there is an additional global corporate minimum taxes that you are talking about. So we are preparing for the corporate taxes, but at the same time, it's, now that you have told us new concept of global corporate minimum tax, so do we have to, how do we start preparing for that?
Excellent question. I mean, first, I guess you need to think about, am I actually in scope, right? So below 750, no worries, 750. There are some interesting questions for companies that are in the margin, 2 out of 4 of the preceding years. There's some specific rules on mergers and demergers. So you need to know whether you're in scope and don't just look at 750, look a bit sort of in the margins whether you're in it. If you're in it, then there's a bit of a question of what's your company's DNA. When did I start reacting? Do I start reacting when it's actually the law? Do I prepare earlier? How long is my preparation time? So what is the judgment that I use? I know, for instance, having spoken with businesses in the EU, because of course they have an imminent directive, so it's more real for them because the directive will become binding law and then it's a question of execution with a timeline. The European directive contemplates 2024 as the date of implementation, so that's in 18 whatever months. So what are businesses doing that are in the EU and in some other parts where I think implementation is closer? One is they have developed cross-functional teams. That's the first one they did. They set up cross-functional teams consisting of tax, finance, accounting, business leaders together to assess where they are, to cross-check against the rule, to stress test a bit their systems about what they can deliver, to have an initial assessment in which jurisdictions there might be potentially top-up tax, and how they would build out their systems. Because the biggest worry, I guess, from the companies that I've spoken to is the IT build time. You know, what new data points do we need to support when the return comes in? That's probably the biggest effort that we have seen, in addition to those that are proactive. They come to us throughout this process and say, look, I'm testing this process now, I'm trying to apply this rule, and I don't have the data to apply this rule. For instance, to give you an example that will resonate with the accounting community, we have a 5-year reversal rule for certain deferred tax liabilities, if there's no recapture exception for certain long time. Now that's drafted in the rules as if it applied to the item. But we understand many of the businesses actually don't carry this on an item, but on a grouped, on a category basis. So they go in and say, look, here's what I could do, here's what I could not do. So in some sense, if you are early, it's not only easier because you'll be prepared for implementation, but it's an early warning system where you can still influence the guidance. So those are presumably some of the things that it would do. And of course, they've gone to the board and said, we need budget. And you know, what the budget approval process is always a question.
Hi, thank you for the enlightening presentation. My question is is it true that shipping companies have been excluded from this proposed tax legislation while airlines have not been? And if it's so, then what's the rationale? Shipping companies are excluded and airlines are not. Thank you.
So the shipping companies are very happy that shipping companies are excluded. The airlines are less happy that the airlines are not excluded. What is the justification for excluding shipping? A very good question. And you can believe that it took quite a while to get to a consensus on not including shipping. At the end of the day, there's countries that decide, we propose, but you need to get a consensus on the scope. You know, there were much discussions on 750 versus not 750 versus others, and there were also other candidates that could have been considered for exclusion, were considered, but ultimately not accepted. There's a number of factors, I think, in shipping. The most important probably is that the vast majority of countries that still have shipping doesn't tax shipping inside the corporate income tax system, but on an alternative basis. And so trying to integrate tonnage tax systems and other non-income-based taxation regimes that currently apply inside a minimum tax was one of the reasons to not include shipping. There were also questions around the application of the under-tax payment rule as a defensive question and some other more technical reflections, but it's also like some of the other things ultimately where you can find the consensus. Other people wanted a bigger substance carve-out, a smaller substance carve-out. But shipping, I think the primary reason, amongst other reasons, is probably the fact that shipping quite typically is taxed on a different basis. Even if it's still in corporate income tax, it's not the same profit computation that we otherwise see.
Thank you, Dr. Rahim. And special thanks for taking us through the critical developments of taxation by OECD. International tax cooperation with a transparent tax system and exchange of information have been essential tool to combat tax evasion. Let us have a big round of applause for our guests. Now I'd like to invite Chairman Sri Anurag Chaturvedi and Vice Chairman Sri Harikishan Rakawat to present a memento to Dr. Rahim Prose. Thank you, everyone. It is now time to hear from our chairman. What's the plan for June and near future, considering the upcoming tax? Let us welcome Chapter Chairman Sri Anurag Chaturvedi to the stage with a big round of applause.
Secretary CA Manoj Agrawal for great opening, and thank you, CA, Mr. Impros, for taking us through the OECD developments altogether. And a very good evening to all of you, friends. Come on, I need to just, you are not enlightened with the session today. You didn't learn about the development, so let me see the energy out there. What is after learning about the tax development from the OECD? Good evening. That's what the thing is. So, eminent speakers of the day, Mr. Impros, Mr. Fazil Sofu, Mr. Alistair Grover, CA Nirav Shah, members and guests, good evening. Friends, as we all know, that tax regime is, coming over all over UAE from all different sort of forms. As we all know that VAT, excise, GSR, UBO, now the corporate tax is also there. So are we all prepared for it? When I say prepared, I have some different question, because some of the questions that I planned already, our own secretary asked the question. But then after learning all these development from the OECD perspective, how many of you believe that you are in a position to assist your organizations and your clients? Can I see the raise of hands, please? None? It's very surprising. It's very surprising. So, well, when I was asking this question, that how many of us are prepared, the reason is we all heard this, we have read it before. But how many of us really understand that how do we correlate all these facts, all these regulations, and all these concepts to advise our clients? It's very new to, obviously, to UAE, the international tax. And the opportunities in international tax is really immense, and that is why this session is today. And I said in my last Chairman's address, is that we are organizing this session for the professionals so that they understand what they are going to witness, how they are prepared to address the client's need. So let me share some of the insights, friends, how the corporate tax, the international corporate tax works, and you understand the planning. So how many of you heard about the global organizations shifting the profit or doing extraordinary planning? How many of you heard? Quite a few, yeah? Quite a few have heard. Let me share one example. So while I was preparing for today's event, I thought, let me share some story rather like, I give you a little bit of gyan here and there. So one of the global giant food chain, we all know that. I'll not quote the name, but then one of the global giant food chain, they were having a tax base, they're having their incorporated organization in United Kingdom, Mr. Alistair's place. And in 2013, they learned about some of the incentives or called rebates were available on their royalty income in one of the European jurisdictions. How many of you know which jurisdiction I'm talking about? Well, not much. So it was Luxembourg. they realized that in Lux there were certain incentives available. And this organization earns a royalty not just only in Europe, but all around the world from. Where the tax rate is somewhere 21%, somewhere is 30%, somewhere is 25%, somewhere X amount. But as Mr. Ahim says that these organizations, the tax is always considered to be levied at the base. So what they did, when they realized that there is certain incentive, they read this particular clause and they analyze in their global income framework to understand that should they shift the base from UK to Lux, how much saving they can generate. And it was in, I will say, millions of dollars that tax, that is a small change drive. So just shifting the base from UK to another jurisdiction, they were able to save millions of dollars in tax revenue. That is just one of the examples. Another example I'll give you, one of the global tech company which probably you may have in your pocket at the moment. So they have learned about very small, and they read between the lines about the residency rules in a particular country within the Europe again. So what they did, because of this residency rule, they were able to again save, I will say, $1 billion approximately tax revenue, and that gets obviously limelight in OECD. So Mr. Ahim Pross is, and other colleagues of him is reviewing this particular case. So let me just give you an example. So this company, what they did, they have taken a concept and benefit of dual Irish company. They set up a dual Irish company, which means a company which is based and incorporated in Ireland. So let's say company A. And then they also set up a company B, which is not a tax resident in Ireland. I will tell you how you can set up a company again in a country, incorporated an entity, but it does not have the residency in that particular country. So this company B has held the IP rights, and it landed over and given the right to company B, the right, and the company A, which is a resident entity, continue to give all the revenue to this company B, which is not a resident in Ireland, which is again controlled and managed by some other country, which is, let's say, company C, which is managing the entire business of this, which is in, let's say, an non-tax regime, for example. So now the company which is not resident, the tax was not levied in that particular country, where the tax is got levied in the country where there's no tax or there's a less tax regime. Can you imagine that how much money would have they saved? The great amount of money that they saved. Great amount. I mean, I can't quote the figure, but then it's extraordinary amount of money. This is one of, or two of the examples that I want to quote to you to understand, to make you understand that international tax, when we talk about as a tax professional, we have to be very, very clear that we need to reach every single word in the sentence that have been defined in the law. Every single word makes a lot of difference. And then we need to read all these provisions sometime together. If you do so, you will not only be able to advise your client and your business precisely to help them efficiently plan the tax, but at the same time help them to comply. The reason is that all of us present here want the tax to come, but the businesses which are here don't want to get the tax because they straightway hit to their pocket. So what we as a professional we all professionals required to play diligent role in explaining people, explaining the provisions, providing them means and ways to plan tax efficiently. The planning is not a crime. Planning is good part because if we understand different jurisdictions, we understand the regulations, law, and if we go by that law, that's pretty legal, I believe. But good thing as a professional that you need to know with OECD, there's a DAC 6. That's called the disclosing obligation, which I'll definitely ask a question to Mr. M. Pross as well. That OECD has defined DAC 6, which is basically a disclosing regulation on the intermediaries. Who are those intermediaries are? You and I. You and I are the intermediaries between the tax authority and the client. So there may be regulation. I'm not sure about when it will be implemented, but there is a discussion around it that we intermediaries are obligated to provide insights to authorities on cross-border transactions, the tax planning measures that probably is taking, the base where exactly is income and base. So we have to be, as a professional, very careful, because there is a concept called DAMP, which is development, enhancement, maintenance, protection, and exploitation, right? So as a professional, what we need to do now, going forward from here as a corporate tax, is about to come. The first is, when we go to the client, understand where the value is created. The most important thing is taxes, as Mr. M is also saying that. Where the value is created, knowing this particular thing is half of the puzzle solved. The second part of the puzzle is what asset and professional create value and profit to the organization. So that allocation of that, you can understand the allocation rules altogether. Basis that, you can analyze various provisions based on the jurisdiction that your organization or your client is operating, and then give them the right strategy to plan their tax efficiently. I will not take much of your time because experts are here. They will gonna talk much more about this entire thing. Now I'll just talk about some future events, friends. As you know that this year's theme is, what is the year's theme? Can anybody help me out to understand? Sorry? Louder a little bit. Well, it's spreading knowledge and creating goodwill, right? Spreading knowledge and creating goodwill is the theme of this year, and this is why we are creating the event, because we want you to be an expert as a real professional, so that when you go out in the market, everybody says that, look, I wanted to work along with a chartered accountant who has real diligent knowledge and they can comprehend well. And we organize this event again to enrich your goodwill, to enhance your knowledge. So upcoming event on 25th of June is, we are talking about Crypto Symposium, because we want you to understand about the crypto world, how it is shaping up. We have done a number of events, but I want to get again back to the basics, that what is really crypto is, how this mining happens, what are the opportunities like as for us as a professional, as an accountant, how do we deal with it, what are the regulations are saying about it. So that's on 25th of June, please dock your diaries. We are having a Power BI workshop, which is a great initiative again taken by our treasurer, our executive committee member, CA Sanjay Gagrani. So big round of applause to them. We are taking a study tour to Serbia. Again, that is planned by CA Amit Ketan. Big round of applause to him as well. Some of the important events which is again coming up are Azadi Ka Amrit Mahotsav. So we are talking about quite a few senior people, personalities out there who can really talk about growing and evolving India on the day. We have yoga, International Yoga Day on 19th of June in World Trade Center. And I encourage each one of you to join us there between 5 to 7 p.m. Really, it says that it's for women, so obviously each and every woman is invited there. I really wanted to make world felt that the chartered accountant ladies are not behind, they're well equipped. So come and try and start your fitness program out there. But besides women, all men are also invited. So please join us there on 19th of June, World Trade Center. The circular is already issued there. And obviously we are planning quite a few more events, which is like on July 2nd, probably we'll be having our first event on Chartered X. Chartered X is a platform for each one of you friends. Each one of you who has extraordinary skill, extraordinary talent. If you have something extraordinary which is not normal, and you believe that it's extraordinary, come and talk to us. We really want our members to know about your talent. We'll be having annual international conference in November, and the expected date is November 28. I'm working with a lot of global dignitary. This time I really wanted to make it 100% international. So when I say international, maybe all over the continent, all continent of the world, I'll try to cover that. So wish me luck to find the great speakers out there to bring out a significantly different experience to all of you. Another important announcement which probably hurt your sentiment, but please understand that when we take any decisions out there, we have taken a decision after due consideration and ratification and value. So we have the highest number of membership since 2018. This is the highest number of membership that we have. So we crossed around 2,750 members out there at the moment. Great work by the executive committee and each one of you. So big round of applause to all of you. But as you know that we are back to 100% normal, which means our activities are predominantly every alternate week, or 3 events or 4 events we're doing every month, because I believe this is a real time to embrace our learning and understanding. So as the membership base is increasing significantly, we decided that with effect from 1st July 2022, we're going to reinstate our fees to 700 plus VAT. So anybody, all your colleagues, anybody in your organization who have not able to pay their fee, they have time until 30th June to pay and renew their membership with the existing rate, which is 500. But effective from 1st July 2022, the membership will be 700 plus VAT. I hope this is a good decision for all of you, because obviously you understand that we bring a lot of experiences and a lot of events that we are doing. So this is in the interest of each one of you. Thank you very much for listening me patiently, and I look forward to other speakers as well.
Thank you, Chairman Sri Anurag Chaturvedi, for letting us know your plan of the future and with increased fees. Let us have a big round of applause for our chairman. And don't worry, this increased fees will not going to affect you. You already paid. So no worries. Be happy that we paid earlier to entitled to attend the events. So in this era of growing compliances and increasing tax rate, our role as tax and finance professionals is also growing. And the focus is now moving towards tax efficiency for businesses and individuals. Again, back to my style. What is tax efficiency? No one? Just try to pay less tax, or not to pay tax, or to plan how to pay minimum tax. To plan. That's right. A financial decision can be considered as tax efficient if the payable tax is lower than an alternative financial structure within the same or equal circumstances. A tax planning or a tax structure is called efficient when an individual or business pays the least amount of tax required by the law. Okay? No one? So with compliance of the law, if we will be or we would be able to pay least amount of tax, that is tax efficiency. A tax structure depends on the tax base, tax rate, and how these rates varies across various jurisdictions. And to share how to develop an efficient tax structure, today we have with us our next speaker, Mr. Fazil. And to introduce Mr. Fazil, I would like to invite our treasurer, C.A. Jayaprakash Agrawal, to the stage.
Good evening, everyone. Tax is always a boring subject, and that's why I can see the noise is not loud, the claps are not there. But at the end, when you learn taxes, this is for the chartered accountants to learn the tax, because there we make our money. Talking about efficient tax structure, it works both ways. For the government, efficient tax structure is when they are able to get more and more money out of the people. And efficient tax structure for us is when we pay less and less tax being in the ambit of what exactly tax wants. So I'm not sure what exactly CA Fazil will do, whether he will tell us the tax structure from our side or from the government side. That I'm looking forward to. But we have CA Fazil, who is a graduate from London School of Economics and is a fellow Institute of Chartered Accountants in England and Wales. He's also a chartered accountant from England and Wales, who specializes in international taxation, tax advisory, and structuring. Prior to joining Anderson, he was director at Oricron, Mauritius, where he successfully set up and developed the tax advisory unit. He sits on Tax Committee of Mauritius Finance, and he's also the government's tax joint working group, where he regularly interacts with policymakers and other key stakeholders. That gives me a worry. He will talk from our side or from the policymaker side on tax legislation policy in Mauritius. He speaks regularly at conference and is often quoted in national and international press. He has worked earlier in PwC, and as well as he has worked in Citigroup. With a round of applause, I can see a smile there. I am doubtful what exactly that smile is for. We can invite CA Fazil with a round of applause. All of us, CA Fazil.
Thank you very much. I feel I've been set up because to talk about tax planning opportunities straight after Achim and the OECD is a thankless task. But I'll try my best. And Achim said he had a get out of jail card. It feels like I'm walking straight into jail with my tax planning opportunities in front of the OECD. But we'll give it a go. We'll see what we make out of it. But no, jokes aside, thank you very much for having me here. It's an honor to be here. It's a privilege to be here. I only landed this morning. I honestly didn't expect such an audience. I didn't expect the scale of sort of the people who will be sort of listening to me and watching and following this. So I'm very grateful to be here, and thank you very much, everyone, for having invited me. The topic today, I want to talk about Mauritius as a jurisdiction for tax structuring and tax planning. But I want to talk about Mauritius in a wider sort of scale of things in terms of what has made Mauritius an attractive jurisdiction for structuring above and beyond tax, and we'll look at the tax angle as well. And then at the end, you can draw your own conclusion as to whether Mauritius is a tax haven, whether Mauritius is a very compliant tax jurisdiction, whether people choose Mauritius for its advantages way beyond the tax attractiveness, or your own conclusion for that matter. So I'll skip through some of the slides that we can focus on the things that matter the most for this discussion. People, and especially when we talk in the context of India and the Mauritian sort of international financial center and the offshore center, as we used to call it, there's a lot of negative perception, I'll be the first to admit it, about Mauritius. That Mauritius has been used over the years to help people avoid taxes in India through the treaty. Okay, it's well documented, and for a long time, the global financial sector, the global business sector in Mauritius was predominantly about businesses being set up in Mauritius for investment into India to benefit from the treaty. But for a long time, and a very long time, the focus of Mauritius has changed from India to the rest of the world, predominantly Africa these days, but Mauritius is being used more and more as a jurisdiction for structuring across the globe. Now, what makes Mauritius so attractive? You will see on here, there's a few fiscal points or tax-related points, like the treaty network, like the fiscal attractiveness and the friendly regime, which I'll talk to in a few minutes. But you will see most of these factors are non-tax factors. And this is important for you to understand, because when people decide, when investors decide how to structure their business, which jurisdiction to go to, they don't just think about the tax elements. Very often, and even more so in the last few years, the non-tax factors play a dominant role in where to structure the business, where to hold, where to have your legal entity and legal presence. I'll take a few, for example. Let me take Africa as an investment sort of area and operations. A lot of businesses structured in Africa face the issue of exchange controls. Now, exchange controls may be something that is alien to many of us, but in South Africa, you can't just take dollars out, you can't take money out without approval from the regulators, okay? And this is across the board in many jurisdictions in Africa. One of the things that people look for in Mauritius is the fact that there is no strict controls and you can freely move dollars, any hard currency, in and out of Mauritius. For them, that may be the most important factor whereby they decide to structure in Mauritius. Another factor may be the fact that the apex court, if you've got a dispute, the apex court in Mauritius is actually the UK Privy Council. So that gives people comfort that if they are in Mauritius, they will always have recourse to the Privy Council if there's a dispute somehow. So increasingly, you will find that businesses are relying on those non-tax factors, which ultimately make that, despite the wave of tax changes coming through, whether it's the BEPS, the different action points, whether it's Pillar 1 or Pillar 2, those non-tax factors playing a dominant role are making Mauritius still an attractive and efficient, as we will see, jurisdiction for structuring investments. Let me talk about, and I want to pick up on one or two things that Achim has said in terms of how that sort of correlates and how that fits into the Mauritian context. You will see on this slide different structures that we have in Mauritius, different legal entities. I'll pick one or two just to illustrate some points, okay? Those who are familiar with international structuring, those who are familiar with Mauritius as a jurisdiction, will know the global business company on the top, the GBC. The GBC has been the main legal entity, the main vehicle that people use in Mauritius to structure their business. It's used, and it's the vehicle that you have to choose when you are a foreign person investing predominantly outside of Mauritius, but using the Mauritian platform. Now, for a long time, the GBC, and I'll take the example of a little island on the side that has a different regime, and Achim is smiling, because that's what we had in Mauritius, okay? We had a regime whereby a domestic company, which does business in Mauritius, pays tax at a certain rate, whereby a global business company, which is predominantly owned by foreign investors, pays tax at a significantly lower rate, okay? And that was allowed to continue for a long time, and to the benefit of the island and to the benefit of the jurisdiction, and we earned from it. Along came BEPS, along came the different actions, and Mauritius had to comply, like in many countries. And the government in Mauritius was fully committed to ensure that, one, we do not have any harmful tax practices, so we are not any blacklist or grey list when it comes to tax, or other matters, other factors for that matter. So we had to revamp our tax system significantly over the last few years to make sure that there was, amongst other things, a harmonization of the tax system between the domestic world, the domestic company, and the global business company. So this is one example where Mauritius, despite being an attractive jurisdiction, despite offering significant fiscal advantages and non-fiscal advantages to structure, despite being still the jurisdiction of choice for people, especially going into Africa, if they need an African presence, has made significant steps to comply with the requirements of the OECD, the requirements of the EU, and the international norms and standards when it comes to matters of taxation. In Mauritius, we've got different vehicles. I mean, I won't go through these in detail, but suffice to say that depending on the type of operation that you have, the type of investment you're looking into, whether it's funds, whether it's personal private client planning. You've got different structures that can fit within those circumstances that you're looking into. This is no different from sort of multiple jurisdictions, but some of these have been very, very commonly used, and many of you will be familiar with them. This is a snapshot of Mauritius. I don't want to go into detail on this, but some of the things I'll pick out. We've talked about the minimum tax. It's funny because this week, I was just saying to some of the members of the audience, we've had the budget in Mauritius this week, and we've just announced a top-up tax to 15%. So for those businesses who don't want to give the extra tax to the parent jurisdiction, Mauritius has taken the lead and will happily collect that tax under Pillar 2. So this is very topical. But this is, and we'll share the slides, this is a snapshot of the tax system in Mauritius. It has evolved, as I say, significantly. So I came back, I was in the UK for a number of years. I came back in 2016, just before all those BEPS developments, and I've seen the evolution of the tax system in Mauritius, working very closely with the government, who've been working very closely with the OECD. And we feel confident that it is a system that is robust enough to withstand the challenges of the future, but it's also a system that continues to be very attractive. Some of these things are quite basic for you, those of you who are into tax. I mean, the tax credit system is as you probably know it. There are exemptions and there are tax holidays for different items. Now, one question that I get asked often is, if you've got a tax holiday, if you've got a tax exemption, and you know that BEPS minimum tax is coming, how is that going to interact with the minimum tax? Now, we've heard the carve-outs for substance. There are carve-outs for things like funds as well. So we'll need to see how exactly those businesses are affected. The good thing that in Mauritius, we don't have a significant number of businesses with more than 750 million turnover, so it's not going to be sort of devastating in terms of the impact. But it's something that the government is following very closely. Another thing that has made Mauritius very attractive, and just sharing with you, is the fact that there's no capital gains tax in Mauritius, and this is something that is set to continue because there's no indication that any capital gains regime is being introduced anytime soon. So that makes, from a planning perspective, as we'll see in one or two slides, it makes Mauritius a very attractive jurisdiction when you combine the fact that there's no capital gains with no withholding tax when you repatriate funds outside of Mauritius. What I've done is I've illustrated in a couple of slides some planning structures, very simple ones. I've been asked to keep them quite simple. But the idea is to illustrate in practice how this can work, so that at least you have an idea, especially for those who have not seen or come across these types of structures in planning before. Okay. So in this situation, we've got foreign investors, typically, who are looking for a platform to structure their investments, and they want to invest in multiple countries. It's a very typical scenario, okay? You have the business or the commercial decision will be, amongst other things, where do I set up a holding company for which I can carry out I can hold those investments? And there's lots of considerations, tax and non-tax, that come into play. But in the interest of time and for the sake of keeping it simple, I'll walk through some of the relevant tax issues that people would consider when setting up the structure like this, and why Mauritius is attractive and why Mauritius is favorable when it comes to these types of structure. So your holding company is going to, there's three levels at which you should look at this if you're analyzing from a tax perspective. So you look at the tax in country, so you look at the tax in the holding company. Then you look at the tax on money coming from the subsidiaries. And then you look at the tax in terms of money flowing out of the holding company. Okay, that's conceptually an easy way to try and sort of break it down and understand it. So the tax in the country, in Mauritius, on this structure will be limited to 3% if we're talking about dividends and interest being received from operating co and trading co. I won't go into the detail, but I'm just illustrating a situation here. When Mauritius repatriates funds out to foreign investors, there's no tax in Mauritius. By and large, there's no withholding tax. And when Mauritius disposes of the operating co and the trading co, there's no capital gains in Mauritius. So straight away, you've got three things that make the whole co very attractive. No capital gains when you dispose of the underlying investments, a maximum of 3% tax at the Mauritian level, and no withholding tax upon repatriation. Go throughout Africa, there's hardly any jurisdiction that can provide this type of sort of combination of rates. Now, why do I keep mentioning Africa? It's because many businesses, many organizations, and many structures require an African jurisdiction for their African investments. And it's funny, even yesterday, I was working on a proposal just before I caught my flight about a significant group, global group, who have their headquarters currently in Singapore for their African operations. And the board says, no, we have to have an African headquarters for the African operations. Likewise, the DFIs who invest in Africa, the development finance institutions, continue to use Mauritius as a base for Africa. It's funny because even in the 18-month period when Mauritius was on the grey list of the FATF, they were being very patient to continue using Mauritius, given the commitment by the government of Mauritius to come out of that list and the actions that we were taking. But Africa is one area. The same structure can be replicated irrespective of where your underlying companies are. Okay? I mean, I don't want to go into too much more technical detail, but suffice to say that these types of structures are common structures that you will see in international tax planning. BEPS may come and play sort of bit of havoc with how these structuring are done, but predominantly you will continue to see the same theme across future structures, despite BEPS and despite sort of the pillars, pillar 1 and pillar 2. Because what BEPS is introducing is global. It's creating a level playing field, so everyone will have to comply with the same rules one way or another. Another structure that I wanted to run past you, again, this is fairly benign and fairly common, is the fund structure. And Mauritius, again, is has been used extensively to set up funds in India, first and foremost, but across Africa and globally as well. The regime in Mauritius currently allows for a reduced rate of 3%, subject to meeting certain substance conditions, which funds benefit from. So funds, as well as fund managers, to the extent they meet certain conditions of substance, can benefit from a 3% tax rate. The other tax elements that I've mentioned in the previous slide, for example, repatriation of funds out of Mauritius, again, there's no withholding tax. Funds received from Mauritius, to the extent that there's treaties between Mauritius and underlying companies, can benefit from reduced withholding tax rates. It's such a large audience, I would have loved to ask questions, but maybe we'll talk about some of the questions in the panel later. But hopefully these two diagrams illustrate a bit how Mauritius can come in the picture. You can replace Mauritius with UAE, you can replace Mauritius with Singapore, depending on the specific facts and circumstances that you're looking at for your client or for yourself as an organization looking to do tax structuring. Okay? Now, I have to say that none of this, and I heard from the chairman that tax planning is not a crime, none of this is criminal. None of this will land you in the bad books of the tax authorities, as long as they're done within the parameters that exist, as long as they're done within the frameworks that you're allowed to play with. Okay? Increasingly, there are tax avoidance rules. Increasingly, within treaties, there are anti-avoidance and clauses and provisions. But so long as you're playing within the rules of what's allowed, every taxpayer is allowed to arrange their affairs to minimize their taxation, as we know very much from case law. There's one more structure that I wanted to mention to you, which is more on the personal side. I know BEPS, tax structuring internationally is more corporate stuff, but there is an element of personal planning that comes into it as well, to the extent that it's combined with corporate structures. So for example, you could have companies or investments, corporate vehicles that are held through a trust or a foundation or similar vehicles, again, to optimize the tax position of in this case, what we call the settlers and the beneficiaries, so people with high net worth. These structures, I don't know how common they are in this part of the world, but certainly trusts have been used for a very, very long time in Guernsey, in Jersey, in Mauritius as well, and they are tried and tested vehicles. Now, one thing I would say is that despite all the changes that are happening, despite all the continued negative press about Mauritius, and there have been quite a bit recently, and there will continue to be. For example, over the last couple of years, there's been a couple of African treaties, African countries, Zambia and Senegal, who have terminated their treaties with Mauritius. Mauritius continues to suffer from the image that has been depicted, that has been sort of created because of the low tax rate, the investments into India, the tax haven tag, as Aki mentioned. And it's something that may continue. We, at the level, as practitioners in Mauritius, we as advisors of businesses coming to Mauritius, we as the government and the authorities are very mindful of that image. We're very mindful to make sure that whatever the jurisdiction is doing is to promote the tax transparency, is to promote compliance with international tax norms and standards, and is to promote fair taxation. So there is, I have no concern that going forward, Mauritius will adopt the principles of BEPS, Pillar 1 and Pillar 2 to the extent relevant, and Mauritius will continue to be a compliant jurisdiction, and Mauritius will continue to be as attractive as it has been for the last 15, 20 years. I know I don't have too much time, so I want to pause here to see if there are any questions, but I think we've got a panel later where we'll have the opportunity to ask more questions as well.
Actually, we need to ask you to clap, because unless we ask, you are just sitting silent. So many thanks to Fazil for letting us know various ways to create an effective and efficient tax structure, and that too without tax evasion. Now let us have a round of applause for our speaker. I would like to invite our chairman, vice chairman, and treasurer to the stage to present a memento as appreciation. Can we have a group picture of ExCom with all the speakers, please? If Dr. Ahim and Alistair. ExCom on the stage, please. As they say, if you want to know something, read the books. If you have already read the books and still want to know, ask someone. In UAE, corporate tax is being implemented from June 2023, and we all have read the books. We know many things, but still wants to know more. Then we need to ask someone who is there in a much more mature tax jurisdictions. And which jurisdiction is best? UK. UK has a complex tax structure with one of the highest individual income tax rate of 45%, VAT rate up to 20%, and corporate tax is 19%. Our next speaker, Mr. Alastair, will take us through the recent developments of UK tax. And to introduce, I would like to invite our executive committee member, CA Dheeraj Ranasaria, to the stage.
Sorry. Good evening, all. Mr. Alastair Glover is a private wealth partner in Dubai, office of Travers and Hamiltons, and advise high net worth individuals and families, family offices and trustees on global estate planning and tax efficient investment structures. He joined Travers and Hamiltons in October 2016 and has been based in Middle East since September 2013. Following 7 years working in London for a leading private health firm. Mr. Glover has significant experience in international succession planning, including regional and international trust and foundation structure, tax advice, immigration, and family governance. He leads the private wealth practice in the Middle East, and he ranked in the Band 1, Chamber Global in Private Wealth Law. Much of Mr. Alastair's work has an international dimension and often involve cross-border succession and tax planning. In addition, he is advising clients on legacy planning involving regional estates and has a particular focus on DIFC and ADGMG foundation structure. He is a full member of Society of Trust and Estate Practitioner, STEP, and he is a current chairman of STP Arabia. He is a regular speaker at conferences regarding a variety of private client issues. So welcome, Mr. Grover, with a very round of applause.
Good evening, everyone. It's a pleasure to be here tonight. I'm very grateful for the opportunity to come and speak to you all, and I certainly, for one, have learned a lot this evening already, and I'll look forward to hopefully meeting some more of you in person, because it is a really big venue. So from myself, if you see me around the place, please do come and talk to me should you wish to, just to say hello or to ask me for some free advice about UK tax, because that is one of my specialties, and people do like to ask me about their own families and their own situations as well as they relate to the UK. And I'd genuinely be happy to have a chat with anyone this evening. So my talk, I'm going to go as quickly as possible, so I'm conscious that we've overrun a bit. What I'm looking at today is really just to give you an overview of some recent developments in UK tax and a flavour for the tax system in the UK as it affects both corporates and individuals as well. So I spend a lot of my time advising people who own businesses, whether they're international or UK. So today I'm just going to run through, as I said, we'll look at corporation tax. There have been some significant extensions to corporation tax recently to non-UK tax residents, which is quite interesting. The digital services tax, which is the UK's attempt to start taxing some of these tech companies that we discussed earlier, but will actually be phased out. And as I said, we'll look at the personal side as well, briefly, which is the taxation if you're an owner of assets or a business. So just thinking, when we're thinking about tax and drawing this together, as Mr. Prost said earlier, you know, a lot of this is political, right? but a lot of it's down to what's actually happened in the last, gosh, I guess it's 15 years now. Financial crisis, more recently, COVID-19. We've seen unprecedented government measures in the UK and government support to the economy, which has clearly been really important in weathering the storm, if you like. But out of all of that, at some point, someone's going to have to pay. At the same time, there are these global initiatives. So what I wanted to have a quick look at is some of these themes, some of the things that are driving the tax changes in the UK. So whether that's transparency, whether that's OECD initiatives, or whether that's UK domestic political policy. So the first thing is think about is Brexit, of course. I mean, that's been a pretty seismic event for the UK in particular and the rest of the EU. Now, as it relates to tax initiatives, DAC 6 was one of the first things that kind of changed. So as an intermediary, as we said before, and having to potentially disclose cross-border tax arrangements, I would have been subject to DAC 6 in full, effectively. But Brexit, things changed slightly. The UK has somewhat watered down its position. It will follow the OECD mandatory disclosure rules, but not the full EU rules. Nevertheless, this drive towards transparency is something that's here to stay. And in fact, the UK is quite, I'd say, fairly forward-thinking in this regard. So you may or may not know that if you establish a UK incorporated company, we have something called the Persons of Significant Control Register, which is publicly available information. And as the name suggests, it's about the substance rather than the form. So it's who is really controlling a company in the UK. And as I said, it is publicly available. To be honest with you, that sometimes presents problems for my clients who may have genuine risks. And there are let-outs where you don't always have to disclose, but the general position is you do. The UK is also very likely soon to introduce or enforce a regime where offshore companies that own real estate in the UK have to disclose their beneficial ownership as well. So as I said, the UK is at the forefront. Expect more transparency rather than less as we progress. So what about corporation tax? Well, first of all, you've got to decide who's actually liable for the tax in the first place. UK resident companies are liable. That means companies that are incorporated in the UK, but it also means companies that are what's called centrally managed and controlled from the UK. So if your mind and management of your company is taking place in the UK, you'll be UK resident for corporation tax purposes. Now, a big change you'll see at the end of the slide, and I'll come back to, is certain non-UK resident companies are now also subject to corporation tax in relation to real estate structures in particular. Sorry. That was me pressing the wrong button. So corporation tax, it is 19%. This is a pretty big deal, though. It's going to increase to 25% from next year. And the UK actually had announced a decrease. So it was supposed to be going down to 17%. So taken together, getting rid of the decrease is one thing, but actually announcing a pretty substantial increase to the headline rate of corporation tax is quite a bold move, I would say, in the UK. I think there was a sense that the UK wanted to reduce it, perhaps post-Brexit, to be more competitive in the international arena, but perhaps now, emboldened by the reality of having to raise revenue, or both, the UK have decided to increase that headline rate. There is some conjecture in the UK about whether it's actually going to happen. We will have a general election at some point in the next couple of years. So some commentators seem to think that this increase may not happen. But I think a general election is a way off yet, so I expect we'll see it. So we talked about these other themes as well that are driving policy. And one of the big ones, of course, has been BEPS. And the UK has one of the major steps in the corporation tax arena is to protect the tax base. And how do you do that? One way is to introduce this corporate interest restriction. Historically, of course, you could deduct your financing costs, interest being the obvious one, when calculating your profits subject to corporation tax in the UK. But now there is this restriction. There is a de minimis. So again, it's not intended to be too much of a drag for smaller companies. So you've got to get to this 2 million threshold before you're into this corporate interest rate restriction. But of course, at the moment, we've got spiraling interest rates. It's not a particularly high limit in the first place. So we could expect to see a lot of companies and groups start to fall within this regime. This is for the accountants, not for the lawyers. I'm a lawyer, just to be clear. I'll leave it to you guys to actually run these calculations and work out these ratios. But basically, this details how that interest restriction applies. Of course, we already have other measures designed to protect the tax base, transfer pricing, anti-hybrid rules as well. But the takeaway point for today, really, I think, is just that if anyone has a UK structure, a UK entity within their group, looking to acquire UK assets potentially, the financing costs and the landscape around deductibility has changed significantly, and it is very complicated, so you need good, solid advice. Now, another big theme, I suppose, that drives policy, of course, is the domestic agenda, what's happening in the UK. And a massive thing, a phrase that keeps cropping up time and again in government consultations, in speeches, is this idea of levelling up. And it crosses a number of different areas that touch upon policy, laws, and tax in particular. So there's the difference in treatment between UK residents and non-residents. A lot's been done to level that up, and in some cases actually make it more punitive for non-residents. We spoke earlier about that idea that the mum and pop store on the high street or the struggling retailer on the high street is suffering. How do you level up against the big online retailers? And that, of course, is about trying to get more fairness in the tax system. So how is that actually sort of coming through? Well, real estate is a massive problem and political problem in the UK. So you've got residential real estate, clearly, people need places to live. There's not a lot of land in the UK, and a lot of people can't afford to buy houses. So it's been on the political agenda for a long time. But the UK have actually gone further now and are starting to drive the changes in tax policy into commercial real estate as well. But now what we have for corporation tax is that if you are an offshore company, so you're not a UK resident company, you will be subject to UK corporation tax on your rental profits, just as a UK company would be. So that means, of course, you're going to be taxed at 19% as an offshore company, rising to 25% potentially in the future. Another big area, again, real estate related, is capital gains. So to achieve fairness, capital gains tax in the UK has always historically been about residents, okay? So that's tax residence of the entity or tax residence of the individual. The principle being that if you are not UK tax resident, then you would not have paid UK capital gains tax on any type of asset whatsoever. The UK has been a bit later to the party, I think, than other jurisdictions in this regard in amending this capital gains tax regime. But that is now no longer the case. So residence is not the only factor, it's the type of asset. So since 2015, UK residential real estate has been subject to capital gains tax. And then fast forward to 2019, this was introduced for all real estate, so commercial as well. And not only does it apply to the land itself, the UK also introduced rules on so-called property-rich companies. And as the name suggests, that means entities which derive the majority of their value from UK real estate, again, whether it's residential or commercial. So major, major change in the capital gains tax regime. For us, it's meant a ton of work in reviewing structures, obviously advising on new acquisitions as well. But it's a big change for investors who now have to factor these tax charges into their financial models when they're looking at making a UK investment and how that's going to affect their exit strategy. Another thing, so this digital services tax, now this has been one of probably the shortest lived taxes in the UK because it's here, it is a turnover tax, it only applies to the really big tech companies basically, but it's very likely that it's going to be phased out from next year if the OECD initiative is successful. Okay, so I totally understand, I'm racing through this, I hope you're following me. I'm going to switch now just to the ownership level and talk a little bit about that. So this is the bit that I spend the majority of my time advising clients on, okay? Obviously, based in this region, we have all different nationalities, but one of the common threads is that people still like acquiring assets in mature markets, and one of the key mature markets for most individuals is the UK. Now, if you're new to the UK tax system, the sort of key factors you need to be thinking about are the domicile of the individual. So that is basically speaking where their permanent home is. Often that's where they're born, but not always. Their residence, and of course the type of asset. We've already seen now that UK real estate has a different treatment. Now, the main taxes for individuals that you need to be aware of are inheritance tax, income tax, and capital gains tax. And this inheritance tax is one that people really struggle with, okay? It's a nasty tax, it's a death tax, and it's a very high rate of tax, okay? 40% potentially on your worldwide estate. That's if you're UK domiciled, so you see the importance of that concept right there. 40% of your worldwide assets. If you're not UK domiciled, the good news is that you're only subject to UK inheritance tax on your UK situated assets, and this is another massive change, and UK residential property held through offshore entities. So that was a big change that came in 2017 and affects so many people who've acquired real estate, whether it's a holiday home in the UK in London, or whether it's building a rental portfolio. There's no easy way to shield from UK inheritance tax anymore, and I spend a lot of my time helping clients to mitigate that tax. There is no way to avoid it. Now, the UK as well, you know, like all politicians and governments, we can be a little bit cynical at times, but I think one area where it's right to be a bit cynical is around what I call the sort of stealth tax rises. So they're not actually raising the taxes, but what they are doing is freezing annual allowances or exempt amounts. And with inheritance tax, that's a really big issue in my opinion, particularly with inflation at the levels it is, and particularly with real estate prices having gone up so much in the UK over the last 30 years. So you have this exempt amount, it's 325,000, but that is not going to change till 2026 and hasn't changed since 2009. So it's pretty naughty, really, in my opinion. What about income tax? Well, as was mentioned earlier, it's a mature market. Mature markets tend to have higher taxes on individuals as well. Lots of services to pay for in the UK. So we do have a relatively high rate of personal income tax at up to 45%. It's not everybody's taxed at that amount, of course. It goes from the basic rate of 20% up to 40% and then 45%. But nevertheless, it's a high rate of tax. Now, if you are, I should have just mentioned one thing as well, because it's relevant to this audience, is that if you happen to be non-domiciled or you have a client or a family member who is non-domiciled and has a lot of money, actually moving to the UK for a period of time can still be a very tax-efficient thing to do. The UK has something that's called the remittance basis of taxation, which essentially means that you are only taxed on your foreign income and gains to the extent that you actually bring them to the UK or you use them. It's an incredibly complicated and sophisticated system, but nevertheless, the broad principle remains that it can be a tax-efficient place for the internationally mobile and wealthy to live, has been proved in recent years. Otherwise, you've got these, if you've got UK source income, you are potentially subject to tax. But again, it's not as bad as it sounds. Now, for non-residents, for example, which is most relevant for this audience, your only real worry is UK real estate income, potentially receiving interest on loans from UK residents. If it's dividends, then it's generally what's called disregarded savings and investments income, and in the hands of a non-resident, there is no UK tax to pay. Capital gains tax I've spoken about, so I don't think I really need to repeat it, other than to say that for anything that isn't real estate, the tax rates are slightly different, they're slightly lower, so you've got 10% or 20% depending on your overall income and gains. And then it is about where you are resident. So if you are not UK resident, you're not going to pay UK capital gains tax on the sale of shares in, Vodafone or whatever it might be, or your own personal company, trading company in the UK. Some other ones that the government have significantly tweaked, and where I say it's gone slightly the other way, so it's no longer fair, it's actually penalising non-residents to some extent. And again, easy target, okay? If you're not voting, which is very often the case for people acquiring residential property in the UK, then you're going to pay an extra 2% on top of the standard stamp duty land tax rates that a UK national, also resident, would pay. I would be subject to that as well, just to be clear. That's really what I wanted to cover today. I mean, there's a ton of stuff that's already been relayed. It's been really interesting from my perspective to hear about it. And I guess I'll just close by saying I look forward to answering any questions that you might have, and otherwise to meeting as many of you as possible afterwards. Thank you very much.
Thank you, Mr. Laster, for taking us through the developments in UK's tax system. Let us have a big round of applause for Mr. Laster. I would like to invite our chairman, vice chairman, and C. Dheeraj Ranasaria to present a memento to our speaker. So after a long time, or say since formation of the UAE, in 2022, everyone is talking about corporate tax. Before that, we were never imagined that, yes, VAT will be there. So they started with VAT, and then now corporate income tax, which is opening the doors for international taxation. We have discussed in earlier part of the today's session that there is no particular tax which can be defined as international tax. But once OECD is going to implement that 15%, then we can say, yes, international tax is 15%. Whatever is the definition or meaning of international taxation, it creates many opportunities for tax professionals in today's globalized world. These days, businesses are exploring different avenues of growth and looking for restructuring, where to set up their base, what are the tax costs and benefits of entering into a new market, and so on. Also, frequent changes to tax legislations and greater scrutiny of tax structures now require ensuring international tax planning for business changes, expansion into new dimension, jurisdictions, cross-border transactions, coordination of international tax reporting, and global compliance management, and similar related other areas. There are multiple opportunities in international taxation. These are not only related to jobs, consultancy, assignment, or up to the business development. These are to learn, experience, simplify complexities, and understand the taxation system, which is the most important part of international taxation. And to get more about these opportunities, our chairman, Sri Anurag Chaturvedi, will hold a panel discussion with esteemed speakers to elaborate more on the prospects in international taxation. For that, we are privileged to have our special guest, CA Neerav Shah, as a panelist with all the speakers of the day. And to introduce CA Neerav Shah, I would like to invite our executive committee member, CA Rishi Chawla, to the stage.
Good evening, ladies and gentlemen. We are living in a global world where any major thing happening anywhere in the world comes to us one way or the other. So we have stock markets, say COVID, for example. So here we have Conference on International Taxation here with us. And such a conference is a delight to hear when we have eminent speakers and panelists with us. So it gives me immense pleasure to introduce our next panelist, the panelist who is going to join us, who we know as a very knowledgeable and a very humble person. But I'll just read out a few of the things which many of us already know. Mr. Neerav, CA Neerav, I would say, is a 6th ranked CA inter, and he also got 36th rank in CA finals. So the people who don't know about the importance of getting a rank, actually passing CA itself is a terrible experience to go through, to be honest. He started his journey working with KPMG in the beginning, and he was working in the International Tax and Finance Department. He has over 20 years of experience from large consulting firms to large family-owned businesses. He conducted various VAT trainings, like with Dubai SME, ICAI Dubai chapter many times, Jain International Trade Organization, GITO, Indian Business and Professional Council. He is also a member of Society of Trust and Estate Planners, we commonly say as STEP. So without taking much time, please allow me to welcome CA Neerav on the stage with us. With big round of applause, please.
Thank you, Rishi. Thank you, Rishi. Now I would like to invite our chairman, Sri Anurag Chaturvedi, to accompany all speakers to the stage for panel discussion. Let us have a big round of applause for all the speakers, moderator.
So I'm sure that all of you have now today understood the great concepts about international tax. We also heard about from the policy makers about the policy changes which is already in pipeline, which is about to come. So a little bit of deliberation about how this international tax is going to impact us. We have heard a lot much, like Pillar 1 and Pillar 2, and essentially in the UAE, since the time VAT is implemented, and followed by economic substance regulation that comes in picture. So we all are filing economic substance regulation today, and we're talking about relevant activities, we're talking about the cross-border relationship, we're talking about the reporting. So my first question to Mr. Rahim is that how will this compliance of minimum standards are being monitored? We have implemented it, but as an implementation, the BEPS initiative, ideally the BEPS should be, the base erosion should be restricted. But what if the organizations and countries, organizations within the countries are not adopting to those norms, and this practice continues, though they implemented economic substance regulation? So how do you monitor that?
Good question. First, of course, as I told you, so far it hasn't happened. The Pillar 1 will be implemented through a multilateral convention that needs to be ratified. So you have hard law. It's not soft law, it's hard law. It's a multilateral convention that will obligate countries to implement. We will, of course, also monitor, but you have a multilaterally, internationally binding instrument. Pillar 2 is a slightly different proposition because it will not require changes to double taxation conventions or the introductions of a multilateral convention. It's also that Pillar 2 is what we term a common approach. So a country does not need to introduce it. If a country decides not to legislate Pillar 2, it's not going to be on any list. No worries about lists. We've had experiences with lists. There's no gray list, black list, or any other color list if you do not implement Pillar 2. But as I said, if you think about the dynamic, if a significant number of countries start to implement it, there will be a natural inclination to want to implement yourself. I'm coming back to the money that is left on the table, and if somebody starts reaching out, other people start reaching out. And so that, I think, is the dynamic. What we will do is coordination rules between countries to make sure that everybody understands which country has which rules, so we can operate this for a global company that operates in several countries. So we need to have certainty about what rules which country has introduced, what that means for the other country, and that's what we will do. And then I guess we have also this discussion, if there is an individual circumstance where you have 2 countries, 3 countries, 4 countries fighting over the same money, we probably need a dispute resolution mechanism inside there.
I think that defines the clear, that answers the entire question. And I will say that businesses today, they need to be vigilant about upcoming time, as you rightly mentioned about that, digital economy, that, and digital tax, and, the digital, the pillar 1. The businesses need to really understand that where these policies, enforcement is coming up. And in due course, it's not just a matter of 1 year or maybe 1.5 years, or maybe 2 years, but then it has to come. So essentially, these all measures need to be looked into from a right tax planning perspective. So followed on that particular thing, I have another question to my colleague, Shri Neerav Shah. So as we talk today much on the top of tax, we're talking about the top of tax. What do you think about in UAE, considering the free zone and the mainland and the transfer pricing that's coming into picture? How this top-up tax, if it happens, will be applied here?
Thank you, Anurag. And before I respond to his query, let me tell you all that we are fortunate to have a dynamic chairman like him. And he is very keen to bring to all of us the value-added events which bring knowledge and skill to all of us. And he is very keen to uplift all of us in that direction. And that's where this entire conference was kind of conceptualized by him. And he asked me to kind of help him. So thank you very much.
No, thank you, actually. Big round of applause.
Okay. When we talk of global minimum tax and its interplay with our UAE corporate tax and all the others, so that's the whole reason why we thought that this topic is very important at this point in time, when corporate tax is coming in. Of course, it becomes a bit more daunting that you to understand both this concept together is not going to be easy. So your free zone benefits and everything will continue as far as the corporate tax provision apply. Now, as we all know that even in corporate tax, they've provided a separate carve-out wherever the company's turnover goes above the threshold of the Pillar 2, which is 750 million euro and above, which in UAE terms it will be about approximately 83 billion and above. So for those groups, the Pillar 2 rules will apply. What does that mean? That means that you forget what is there in corporate tax. So you don't look at the corporate tax provision. You don't look at if you're enjoying benefit of free zone or others. That's not going to be applicable. Because then, like Dr. Pross said, you need to start then compiling your financials on a country-by-country basis. Look at whether you're paying effectively 15% in each country. And if not, the top-up tax will apply. And therefore, we do expect UAE to bring in what Dr. Pross suggested is qualified domestic minimum tax, minimum top-up tax. And because UAE will not let anybody else collect that extra 6% in his example, and they would be more keen to collect it themselves.
Yeah. I mean, on the same note, actually, the fact is that international tax is there, obviously. The corporate tax is coming out there. How do you advise all our professionals? What are the key things, if I really want to ask you, what are the key things that you want to tell all these people out there who learn today the concept of international tax? I mean, we all know that, there was a very less number of professionals who were aware about the
the key concept. But the opportunities are immense. I mean, UAE is a home for 203 nationalities out there, where this around 500,000 companies are there, right? Which has a base across the world, and the world's companies are coming in here. So there's a lot much on the international tax space that is there. So what is the key advice that one is they do that to the businesses?
So as I have been a professional in international tax arena for last over 2 decades, the basic thing that you look at and the skills that you need to adopt is very simple. That look, this is an area of practice which is going to be relevant all the time. So it was relevant when UAE did not have a tax for me, right? So it is still relevant when UAE brings in corporate tax. And it will be even more relevant when there is global minimum tax. The idea here is that it is basically, you need to understand that this is going to trigger when you have operation in more than one country, and therefore there is a difference where you want to allocate taxing rights and who should pay tax where. And that question is going to be asked all the time. Now forget companies. Today families are becoming multinational. A typical UAE family will have children going to study in UK, US, and ending up staying there, and then taking up even citizenships. And all of that is definitely raising more questions on how they should be protecting their assets from not getting taxed in UK or US under their inheritance tax or estate duties and whatnot. So these are different things that we are not. So yes, I do understand that UAE, we are not used to, first of all, tax. And now we are going into corporate tax, and then we are going into international tax. So it's not going to be easy. I'm not denying that part. But this is definitely a specialized area which one should not overlook. And if one need to, we can guide them on how and what they should be doing to pursue that area of practice. I mean, we'll be more than happy to share that aspect as well, you know.
Thank you.
But it's definitely recommended.
Thank you, Senior. Fazil, on that particular note, as you say that, as you mentioned in your presentation about the Mauritius being a good place for the tax planning, considering like, you know, from a non-tax to a tax regime, we have number of businesses here, which is pretty diversified. They have a lot much investment back in Africa out there. And besides Africa, they do a lot of trade along with Africa here, because if you see that one of the zone here, which is DMCC, I mean, most of businesses from there to, or even Jebel Ali or from any other free zones, happens towards Africa, right? So how do you think that Mauritius can play, what kind of role the Mauritius can play, what kind of opportunities are there for professionals here to use the route as Mauritius to efficiently plan tax? Is there something of that sort you can add?
Yes, thank you. Before I answer that question, I just want to pick on something that Nirav has just said. And the tax rules and the tax landscape is going to evolve significantly over the years, in my opinion. I think what we've seen over the last few years is just the beginning of a wave of change. Who knows? I mean, Achim knows better. Maybe in the future we'll have Pillars 3 and Pillars 4. I don't know if these are in the pipeline yet. But the need to learn and understand and adapt very quickly is, you know, as important as ever. So that was just my one comment on that. To come to your question, Anurag, on opportunities that exist for businesses here who have operations in Africa, certainly for Mauritius. And one thing I need to say is that Mauritius is not, each situation needs to be looked at by its own merits. In some cases, Mauritius may be better than the UAE, for example, as a holding location. In another, maybe the UAE is better because there are different critical factors at play. But if you are considering a situation where you want to externalize and you're thinking of a different jurisdiction, then certainly Mauritius offers those advantages. If you look at the fiscal advantages, exports from Mauritius are taxed at 3%. I know it's 0 here, or it will be 9 soon, or whatever the rate is. But that's a preferential regime that has been cleared by the OECD, by the way, in Mauritius. And then all the benefits of structuring through Mauritius, whereby, as I explained previously, there's no withholding tax. It's a subsistence regime, and it's something that's tried and tested. Plus, the fact that Mauritius belongs to Africa. Often this thing gets overlooked, but in many business decisions, it's something that plays an important role. The fact that Mauritius, even sometimes when people say Mauritius is the gateway to Africa, some people take offense to that, saying Mauritius is part of Africa. So it is an alternative jurisdiction that's closer to where your operations are. And then the non-tax factors. Mauritius is part of the same trade blocks as many African countries. So you can freely sort of trade without duties and without those controls. Mauritius, we know the landscape in Africa, especially Eastern and Sub-Saharan Africa. There's so much sort of transactions and activities that have taken place between these two regions. So there's a lot of opportunities.
I mean, there's a lot of opportunities. Essentially, like exports is a critical way to look at that. And essentially, withholding taxes. I mean, the UAE also announced that it's going to be 0% withholding tax. Initially, it was no withholding tax. From there to 0, and probably what else we can and see by the time regulations are coming. So yet to see. But then there's a definitely great opportunities for all of us professionals to see various jurisdictions where we can really take advantage. So now coming back, as I learned today, the rate of tax in the UK is interesting fact, from 19 to 25%. Within the UAE, there are a number of businesses. I mean, essentially, as a family-owned businesses or their trust, they hold significant amount of real estate in the UK. So a lot of our friends work in family businesses, which has investment in UK. So how do you advise them to what kind of consideration that they should ideally look into to plan, and what is the way out for them to have this 6%?
Sure. I mean, I normally tell them to sell it as the first thing, but they say no. So then we say, well, what can we do with the real estate? Now, the distinction that I perhaps didn't convey between residential and commercial is so key. You have to look at it in all cases. But if we're talking about commercial property, it's still a very attractive investment through an offshore vehicle. So it could be Mauritius, it could be the UAE, it doesn't really matter. Because you still put in effect that blocker in place for inheritance tax. So if you're not domiciled in the UK, buying commercial property, you will almost always do it through an offshore vehicle of some sort. And this actually goes to sorry, just going on a bit of a tangent, the question that you posed earlier about opportunities. I think one of the things that's really interesting for me to see what happens, but what I think is a big opportunity for Dubai and the UAE is as it becomes more sophisticated, it's a country that has some substance. It's got a growing financial services sector and so on. And professional services is obviously key to that. A lot of big companies, accountancy firms amongst them, headquartering here and so on. But having that expertise and all of us being able to, and forced in some respects, to become more sophisticated, I see as a real opportunity from an industry perspective. And I think we've got the talent and the people here to get there and be and cement a very solid place in the international sort of financial services sector, including accountants and lawyers. At least that's what I tell my bosses anyway. So let's see what happens. But going back to the real estate very quickly, when it comes to the residential, there are still things you can do for income tax. So if you compare those rates of tax that we looked at, so we've got 45% on the one hand for individuals potentially, versus maximum still 25% for a company. And remember that I said we can, if we're not resident in the UK, we can take our dividends without paying UK tax on those dividends. Then you can see that there's a significant potential advantage to using a corporate structure for investing in the UK still from an income tax perspective as well. And then there's one little point that's worth mentioning there. Leave aside the corporate interest rate restriction, and let's assume it's because you can go up to 2 million, so in most cases won't be relevant.
if you buy a UK property as an individual, then you're only allowed or given credit, a 20% tax credit for your finance costs. Whereas if you're a company, you can deduct all of your finance costs. So there's a significant benefit of taking debt and reducing your taxable profit in the UK using a corporate structure still. So I know it's pretty complicated, but it still helps, and then there are lots of other things.
I mean, it's very interesting to know that, when we advise a lot of clients, essentially, that if you have, let's say, business of services, I mean, I'll talk about goods about. If your business services from UAE to United States out there, how many of you know that there's no treaty between US and the UAE for that matter? And if the treaty is not there, you need to look into some other jurisdiction where exactly the number of treaty is there, so you can structure your way out the inflow to take the benefit of double taxation kind of stuff. Lot many of those jurisdictions, if you route it through United Kingdom itself, there's a lot more advantages that you can drive out of that. I mean, essentially from an withholding tax perspective, on the dividend or on the interest, there's a much more incentives that is available if we take out the route of UK. So there is much more to explore in the UK, and UK holds a lot much significance from an UAE perspective because there is a lot of investments across the places out there from there. Now, coming back to Mr. Ashim, is that we have seen that the CBCR reporting is there. A lot much is happening. People are talking about CBCR reporting, but essentially, I want to know that was it really helpful to enforce that profit shifting to the transfer pricing monitoring kind of stuff? Was it really helpful, or it's still evolving? Like, for example, even in the bank, the fund transfer pricing, FTP, is just to be pretty significantly tried and tested to kind of avoid what are the norms that banks were taking initially. So I want to understand your perspective on that was it helpful and how it is happening around.
I mean, we don't have a quick answer, so I'm going to keep you in the room for another half hour while I talk you through loads of stories. No, I won't. I can give you the long answer. So this has come in, and CBC reports have been filed, and the CBC reporting at the OECD is not public. It is going to other tax administrations. And then it's going into a risk assessment, a risk engine, essentially. And these risk engines are different depending on the country. We have some that are highly automated, operate predefined algorithms, take in different data sources, come up with risk filters, and that's how they target their audit. So there's no single data point that necessarily triggers the audit. It's basically taking in different red flag indicators, running systems across, and then determining your audit strategy. And it's quite difficult in an individual case to then prove which part was the one that triggered the audit and what was the yield of the audit, and can you trace that back to CBC? Because it's a multitude of factors. We have had examples where it has triggered audits that have delivered additional yield, which depending on, as you were saying before, I guess one of your colleagues, depending on where you sit, is that good from a government perspective? Yes, very good. Yes, additional revenue. From the other side, not good because less money for you. So depends a bit where you see whether that's good news or bad news, but it certainly has been used. The other thing that we see engaging with large corporates is, of course, that the board is much more involved in taxation for large corporates than it used to be the case. The board does not want to explain why I have this small pocket of profit in this particular jurisdiction. It creates all sorts of tensions in the wider. These are largely publicly listed corporates, right? This is not so much private wealth. These people are in the public domain. They have branded products that they want to get to their consumers. It's a completely different mix of behavioral factors that drive that. And so with sort of tax in the boardroom and that, we have seen a number of structures where people have just shut it down if it was essentially done for tax reasons. If you are in a place that has substance, and this is the point that you made, it's very true, like where we are here, where there is, there's services, there's reason, there's a regional hub, like that is a different story. But if you have a cash box that basically is an accounting gimmick that you keep some money because you've been able to transfer price it into this location, some of these things, I think, have clearly disappeared. Now, if we then fast forward, of course, is if you think about it, what CB3 reporting does is it gives you a jurisdictional ETR. Relatively rough justice, right? We allow different data sources. It's a bit of a mix. It needs to be consistent for the company that files it, but it's not the same across companies. So you can't really cross-compare. Now with Pillar 2, if Pillar 2 comes, we will have a much more specific ETR calculation. So some people are also wondering, well, if you have the one, do you still need the other? What are the relationships between the two? So we'll see that, but of course, that also very much depends on to whether the pillar will actually happen.
Thank you so much. I mean, this is very important part. We have seen that when the CBCR regulations came here in UAE itself, a lot of business was apprehensive about how they make this entire the local file and master file out there. What is the price that they ideally should use? But they were very apprehensive about whether it is going to trigger anything out there, who will going to transfer the data, will this entire authority to authority talk will happen. But then good to know that there is a lot much progress in this particular area. So we all need to be vigilant. We need to advise all our clients and our businesses that look, we need to be vigilant about. We need to think through that. Somebody somewhere is reviewing the information which we are filling in the spreadsheet. So when you're filling the spreadsheet, it has to be really factual and not just hypothetical certain numbers that you're putting together, jargons out, jargon in, but somebody is validating those figures. So coming back to that point to Nirav again. So Nirav, you see that between the free zone and the mainland, they say that they'll follow OECD guidelines with respect to transfer pricing. Do you think that the businesses are ready at this point in time to adopt that?
So it's very tricky. When you want to, when the concept transfer pricing started, it was more about protecting the tax base of a country. When you start expanding that into transactions which are domestic, you always kind of complicate that. Yes, we do understand that the reason or rationale for it to be in the corporate tax law consultation draft is that if the free zone is taxed at 0 and you have 9% normal rate, you want those transactions to be at arm's length, right? So rationale is there. But if you ask me whether today can you see anybody ready for that? No, not at all. Because here we are not even used to do proper accounting. Forget coming to an arm's length. Okay? So now the role of accountant is going to be very important in the new taxing world order, which is what Dr. Pross highlighted today. But with that, consistent accounting policies. But major challenge for the entire GCC region from a transfer pricing point of view is non-availability of reliable public data. Because transfer pricing runs on benchmarking. For benchmarking any particular transaction, you need publicly available data. If you have only 40 or 50 companies registered on your stock exchange, you don't expect data to come. And then you don't expect exactly benchmark transactions to be available. And therefore, typically even today for Saudi and Qatar, they end up going to Eastern European countries and take that data as somewhat relatable benchmark, which it is not, but that's the only available data. So if you ask me it's a challenge for UAE FTA also to implement this. And in fact, one of the feedback that we gave is that don't have it for domestic transaction because it's not going to help you.
No, but essentially, if you see that businesses within the free zone and the mainland, when they try to do the transfer out there, there's a lot much that they can play around. So transfer pricing is essential.
It is essential. How to implement is a bigger challenge.
But my question to all of you here out there, how many of you operate out of free zone? Free zone.
Most of them.
So lot many people are there free zone.
Yes.
So do you read this provision about the transfer pricing? Yes or no? How many of you yes? Very few. Which means they are not even read the provisions that what is going to come. So the law is going to come. The transfer pricing is going to be implemented. and you're not even reading the law. It's quite surprising, you know. And it needs research, right, Mr. Prost? I mean, it needs a lot of research. It needs a lot of policy-driven things, which takes not just 1 day, 2 day, 1 week, or 1 month. It may take like 6 months or 8 months to do that analysis, to build in within the system. When you're going to be ready? Tomorrow the tax is going to be implemented. The law will be out. When you'll start going to do things?
Transfer pricing has developed in a quite complicated art form, admittedly. If you go through the OECD transfer pricing guidelines and you want to be an expert in transfer pricing, we'll have to be here much longer than tonight and tomorrow night. So bring your food and lock the doors. But I think one of the things that you mentioned, and I just wanted to comment on briefly, I mean, we talked about the pillars. There's many other things that we didn't have time to talk about that the OECD does in international taxation, global mobility, digital tax administration, but also in transfer pricing. Transfer pricing was created assuming the presence of a certain infrastructure, data points to develop comparables. And that is true in many of the traditional OECD member countries. One of the things that we're doing under Pillar 1, Amount B for those that follow it in detail, is to get to situations where countries do not have comparables, and so then you cannot apply it. And we're trying to develop simplifications that would address the situations that you mentioned, that you then have to go to other jurisdictions that may or not be comparable at all, just to have the comparable infrastructure. So we're working on simplifications that would allow to address situations where there are no comparables, to operate a simplified system for distribution at the moment. So it's very much focused on distribution activities. It's not every activity, but we'll road test it on distribution, and then maybe we can go further to address that situation. But coming back to transfer pricing, if you don't need to know transfer pricing, scale up. It is doable, but it is quite an art form with more pages than even the pillars.
Yeah, so I request each of you to go through, at least read the basics, so that you can educate your promoters, your client, and your peers out there that this is something that you really need to address about from free zone perspective. And even not free zone, if you are in mainland entity, if you are dealing with related parties outside, which many of you would have been doing so, this is going to come into picture. This is going to haunt you. So be ready about that. One final question to my other peers out there. So considering like UAE now going to implement corporate tax, so Fazil and analyst, from your perspective, one by one, if you can guide us, that what kind of opportunities that you see that the businesses here can take in your jurisdictions for certain sectors, so that people can reach out to you or to you to help them structure the right ETR. So what you think, in your opinion, can help the UAE businesses in your jurisdictions or in your jurisdictions? So I'll start with the UK.
It's a difficult one. I suppose, are we talking about the businesses that are clients of ours, or are we talking about us as businesses? I mean,
yeah.
If it's us as businesses, I think it's the point I made earlier, really, that, so I actually, just to be clear, I should have said this at the beginning, if it wasn't clear, I live in Dubai. I've been here for 9 years, worked for a long time in the UK and London, so I have seen both sides of it. But I think with VAT, I think with corporation tax, I think with the legal frameworks that are available in DIFC and Abu Dhabi global markets particularly, I think it's about a maturing market. You know, it's still an immature market at the moment, relatively unsophisticated, but that sophistication is coming. And it's being enforced in some ways, but it's a good thing, and I see it as an opportunity for all of us in professional services, because with sophistication generally comes complexity. New rules means somebody's got to review them. It's got to be us guys, and we've got to interpret them as well. That's the other thing that lawyers do particularly, is obviously we interpret, but a lot of this, as we've discussed, is based on accounting principles and not just the words. So it's going to be a combined effort for lawyers and accountants to help our clients to navigate through all of this complexity, and whether that's something like with corporation tax, where you have a free zone entity, but it's doing business onshore and deriving revenue from there. What does that mean? Are you going to have 2 entities or 1? Probably 2. But you know, let's see. There's all of these questions that are going to come up, and those questions are coming to us, and we need to be ready to answer them.
Perfect. So Fazil, what do you want to say about?
Yeah, I think that there's, you know, there's different things that can be done, but again, you have to look at the circumstances around your own business, and I take your question from the perspective of, you know, a company or business, an organization having to make commercial decisions now that corporate tax has been introduced here. Let me give just one example. Previously, if you carry out an exports business here, you know, or in the free zone, you could, you know, pay, there's no tax, okay? Maybe with the corporate tax, you could end up paying 9% in the future, or 15%. But assuming you're not in the 15% bracket for global minimum tax, so you're smaller than the 750 million threshold, in Mauritius, a company that exports goods, and the export doesn't have to be from Mauritius. So the company is incorporated in Mauritius, it buys from China, it sells to Africa, it pays a tax rate of 3%, subject to some minimum substance in Mauritius. So these are practical opportunities that may exist that previously wouldn't have been attractive because there's no tax here, that suddenly businesses can start to consider. And like that, there are other opportunities as well, and I won't go into the detail, but suffice to say that these need to be explored on a case-by-case basis to optimize the overall tax structure.
Perfect. So thank you, gentlemen, for joining me on this panel discussion. Yeah, so we'll take some questions from the audience as well.
My question is to Nirobhai. See, as you consider on the transfer pricing and arm's length, I would like in LLC companies where management remuneration, management fee are being taken for obvious reasons, and transfer pricing will apply as per consultation document which we have. How the arm's length price or how the comparable or benchmarking will be done for this kind of transaction? Any guidelines or any your views on the same?
Of course, we'll wait for the law to come out to give us the precise way of working on that. But I mean, if you ask me generally, you have to see what is the adequate remuneration for the role that the director or the owner is performing. In a similar role in a multinational or anywhere else, what kind of salary bracket it would command. And I mean, there are lots of HR surveys on benchmarking the compensation. So you might have to use those rather than comparable companies' data to see whether that level of salary is what you are paying and whether that becomes adequate or not. So we'll have to see how and where to draw a line, but you have to see from where you can get reliable, comparable data. And that's what you need to look at.
And essentially, you can go to a lot much or research companies out there. DNB is there. There's a number of other companies are there. CRIF, DNB, the credit bureaus out there. You can take those reports on industry specific that allows you to benchmark your product at that particular price. Yeah. So there's a lot much about.
I mean, there is a lot of compensation benchmarking done by HR companies. So you can use some of those and try and keep it.
Hi, thank you for a nice session. I have a very generic question. Keeping in view the current Russia and Ukraine situation and scarcity of the resources in the Europe and other area, what do you think of implementing the Pillar 2 rule by March 2023? How it is, I mean, is it possible or is it like just a hypothetical target?
The European directive, to start with, the legislative proposal that's currently in front of the European Council, has a 2024 date. As I said before, the pillar is a common approach. So that means a country may or may not adopt a pillar. If you don't have to do it at all, we will not put you on a list just because you're doing it late. There's no logic to this. So I think what we're seeing, we need to see a bit what happens in Europe, and most likely they will set the pace on the timing. I think the UK at the moment still has a 2023 date in its public consultation. So we can't rule out. Maybe you can't roll it out, but you can't rule it out. That it happens earlier. But I think we'll have to see. So for at least from where we sit as OECD, as the inclusive framework, countries don't do Pillar 2. That's fine. Somebody else will probably take the money. But if they do it at their own pace, that is also fine. We just need to make sure that the coordination still works. And that, of course, is a question, because, for instance, as I said, there is this reverse, the under-tax payment rule that comes in, and we want to give time for countries to implement the primary rule, the income inclusion rule. It's the easier rule, it's the CFC rule. Whereas if they don't, and other countries go faster, in some sense, the secondary rule may be first at the starting block, which wouldn't be an ideal scenario. So there's some questions around this, but I think we're probably seeing sort of the 24 as maybe, let's see, the direction of travel.
Yeah. And I think most of you know the CFC rules, right? Controlled Foreign Corporation rules. So it's important that, we all need to read about the country in which you're doing this particular transactions and where the headquarters are based, so you can understand the CFC rules and then analyze those on the subsidiaries or branches where other jurisdiction you're operating and see that how it actually, fits in and what are the implications out there. Yeah.
Yeah, hi, thanks. My name is Vinayak.
Little bit closer to Mike.
Yeah, my name is Vinayak, and thanks for this excellent event. I had two questions, which I think my friend already asked one, so I'm left with one. Mr. Akim, you mentioned that you are looking for some kind of simplification of this transfer pricing rules and regulations. Is it likely to come before the corporate tax becomes applicable to UAE companies? The reason why I'm asking is, we did try to do a mock working for one of our clients. And as the panelist, Mr. Nirav Shah, really, as you observed, there were no benchmark for us to really work on. So it was good to know that something simplification is being worked on, but whether it will come before 2024. Thanks.
Now, what we are working on as part of Pillar 1, but there's only so much you can cover in 40 minutes without boring you with too much detail, is that we want to streamline transfer pricing for distribution activities. Because there's a lot of dispute around distribution activities where there should be relatively little dispute, but there's a lot of dispute. So if you look at the mutual agreement procedure that we have between countries, if they can't agree, it's an increasing number of cases, and a significant number of these cases between countries are around distribution cases. So we want to simplify this. And one particular issue that arises inside this problem is for those countries that don't have local comparables. Because then you need to agree on even more data points. You not only need to agree that those are the right comparables and you use the right search criteria and we have the same vision, you even had to discuss whether the base data used is even relevant before you even get to the further questions. So you have another layer of potential disagreement. So that's what we're trying to remove. And the plan is to get this done before year end. Now, whether and to what extent this can be used as a basis for, as you explained, would effectively be a domestic application of transfer pricing, I don't know, and of course that needs to be determined by the applicable rules and regulations.
So let me just add to that. So there are two aspects to this. One, what under Pillar 1 and under Amount A and B you're trying to do is only with relation to the distribution activity. And it doesn't cover many of the others that we want to look at benchmarking from that perspective. That's number one. So the short answer to your question is that we are not going to get any further guidance or simplification on application of the current standard transfer pricing guideline as you have it. You might have something to fall back on, but that's primarily for Amount A and B working from distribution point of view. Whether that will then apply equally into the transfer pricing rules and not and whatnot is a separate subject in itself. Yes, UAE is going to follow the OECD methods, and therefore we'll have to follow the currently available standard methods.
Yeah. And it's quite distinct. I mean, it's not something that which is very unique. They adopted it very rightly about the globally standard methods for the transfer pricing. So I think that is the most simplified way at the moment that we look into that. It's a more simplified way. Any other question?
Yeah. This is Bhavna Jadhav. Throughout this discussion, when we say that a framework is evolving and the challenges that we're going to face in actual implementation of the tax structures, I think the biggest challenge is going to be in incentivizing the taxpayer whether it is a corporate or whether it's an investor. So I think we need to look into that aspect in order to make that fairness, the fairness part of it workable.
See, unfortunately, I'll just take it. Unfortunately, the fact about that, the taxpayer who are pretty, they're compliant people, nobody think about the being compliant part. Every policy or every enforcement that happens to avoid any non-compliance, right? So all what the policy which is developing at this point in time, evolving and structuring that is happening, is learning from the instances where exactly people are finding the loopholes. We as a professional, whenever the law comes in, we just crack it. Wherever the possible cracks are there, identify it and try to roll it dice. Like the example that I shared in the beginning itself. The people is finding out the real word by word law and they try to connect the dots. And if you find a mix, that's where the policy loopholes are there. But nothing can be fixed because the global, two people can't be on the same footage. We are talking about 160, 180 people out there and authorities and different people in authorities. It will be, I think, Mr. Pross can examine that. I mean, that how do you find these people to come together on that particular consensus?
I mean, on the loopholes and finding the loopholes, I mean, there's also something where you can be technically very smart, but strategically very stupid all at the same time.
Yeah.
Some of the structures that you explained earlier, somebody was very smart to found not just a offshore company, but a complete non-resident, a nowhere company. Somebody designed a nowhere company. It was registered in places, but was not tax resident in any single country. And that person on that day probably thought that was really good and probably billed a lot of time on this. But it turns out that when these structures come up, the tax policy reaction and the reaction of society makes the pendulum swing in exactly and in the opposite direction. So it's one of those things that individually probably smart, but very stupid for the profession as a whole, because it triggers an overreaction also on the other side, which makes everybody suffer. So there was a little gain for somebody and big pain for a lot of people. So that's also something one needs to reflect in when one does the structuring, sort of the collective responsibility for the wider community and what happens when the response comes. On incentivizing taxpayers, absolutely. There's a lot of stuff that we're doing in tax administration that are different models of compliance. We do some work with tax administrations that are trying to reflect on how can we assure corporate income tax without audit. There's many commissioners in some of the Nordic and some other countries that have systems approaches. How can we get a cooperative working relationship with taxpayers so that we collectively assure the corporate income tax that comes in without having to torture you with audits and other things. Like there's different relationships that can be created. On the pillar 2, in terms of an incentive, but that's not specific to the taxpayer, but also more widely, not something that applies, I guess, in the UAE because you're just introducing tax measures, but for many, many other countries, look at the UK, look at the Germans, look at many, many of the OECD countries, there's also the question, can we then remove certain measures that we currently have, because now against the backdrop, against the global minimum tax, they're no longer necessary. What does it mean for CFC taxes? Can CFC taxes change? What does it mean for denial of deduction rules that we have? Do we still need them if we have assurance that in the other country there will always be a 15% effective tax rate? So which measures do we no longer need, and can we then simplify it because we have this broad-based, globally applicable, if it comes, minimum taxation? And then many of those things that we have in the attic that still sits there that will be introduced, maybe we can actually remove some of those as a measure of simplification. And that's certainly in sort of the policy space for some of the larger corporates, an aspect that they have in mind in their engagement with tax policy decision makers.
Thank you.
Hi, my name is Lakshmi. First of all, thanks for this great session. I have a very specific question. We have a cross-border agency agreement in place where we actually get commissions from the overseas principal. And the public consultation document of the UAE corporate tax basically says that this would be, the dependent agent concept would be linked to the OECD. Now the problems that we have is we do not have a double taxation treaty with the overseas principal. So will this be leading to an immediate PE in UAE?
So one is that you already have an entity. if I understand correctly. So it's a company which is set up, right?
Exactly, yeah.
So the dependent agency concept for that to apply is not for the parent subsidiary relationship. It's where you, as part of permanent establishment concept, where you don't have a physical presence or a license and things like that, is when you only have an arrangement, a contractual arrangement. And if somebody represents you, that's where that concept will apply. For you, you are already a registered company in UAE, and therefore, depending on whether you are able to claim benefit of the free zone or not, you are taxed at a normal headline corporate tax rate. And of course, if the parent is or a related party is paying you that commission, the transfer pricing and the benchmarking will also apply.
Thank you. Thank you so much. Thank you everybody for sharing insights with all the members out there. I'm sure everybody will take a little bit more insights into this and plan things well.
Just one more time that I just want to thank Dr. Pros. Specifically, like we told you earlier, it's very rare for the OECD to be amongst people like us, because they are more doing a government to government dialogue and busy making all the policies. So I really want to thank Dr. Pros to take time from his busy schedule and come amongst us to share all these insights with us. Thank you.
Thank you very much. A big round of applause again for the moderator and speakers. Ladies and gentlemen, as we have reached the last part of today's event, it's now time for vote of thanks. बाहर बहुत भीड़ है, थोड़ा बैठ के vote of thanks भी सुन लें आप. Otherwise you will complain, crowd बहुत हो गया बाहर. It's now time for a formal vote of thanks. And for formal vote of thanks, I would like to invite our ExCom member, CA Malavika Kolera, to the stage.
No duty is more important than giving thanks. On behalf of the Managing Committee of ICAI Dubai Chapter, I extend a hearty vote of thanks to our esteemed speakers and panelists for sparing time from their busy schedule to address our chartered accountants. Every knowledge and insight shared with us today on this platform are valuable. I would also like to extend this vote of thanks to our sponsors, whose contributions are always vital for us to continue our important work of spreading knowledge and creating goodwill. A shout out to our title sponsor, Saudi German Health, principal sponsors, Pan Emirates Home Furnishing, AGMC, Tally, IFCO and Lulu, platinum sponsor, WMS, CloudSouk, Emirates Chartered Accountants Group and UHY James, FMCG partner, Aktia, media partner, Khalij Times, banking partner, Bank of Baroda, and institutional partner, Delhi Private School. A thank you to all our members for your encouragement and support in today's event. As we come to an end of this event, wishing you all a good evening and see you all soon. Thank you.